Got tiempo. We're going to call this meeting to order. If we could have a roll call, please.
Governor Michelle Renaud Grisham. Land Commissioner Stephanie Garcia Richard.
I'm here.
Treasurer Laura Montoya. CFA Secretary Wayne Prost. Present. Nick Tejas.
Present.
Scott Allen. Thank you, Nick, just joined us. Catherine Allen.
Here, present.
Nick, I have you down. John Bingaman.
Present.
Kelly O'Donnell.
Present.
Alan. Okay. Alan Sanchez. Present. Fred Summer. Present.
The treasurer's here as well.
Okay, I'll mark her down. 9 present. We have a quorum.
Good morning, thank you.
Approval of today's agenda. Any motions for approval?
I move approval of the agenda as presented.
We have a motion by member Summer.
Second.
Second by member Sanchez. Any discussion on the motion?
Just one question, Madam Chair.
Sorry.
I know we're going into executive session. Is there anyone that's listed on public comment?
There is.
Should we move public comment before we go into executive session?
Charlie, do you want to address that?
Madam Chair, so we have two people signed up for public comment. One has canceled. The other one, I have not gotten a confirmation that they'll actually be here on time, so I'm not sure if they are actually on, looking at the list. You can check real quick if there's a Carlton Bird here, if they could do public comment. Carlton Bird with ATI Partners. Do not have them here at this time, so.
If we could move public comment before we go into executive session, just in case anyone does want to speak, I think that would be more advantageous for them not to have to wait because we don't know how long we'll take.
So then, what's your motion?
Madam Chair, I'll accept the amendment that's presented by Treasurer Michelle.
And so just move it to,
Move 7 in between number 4 and number 5, Madam Chair, please.
move 7 to be after 4. Any discussion on that amendment? Hearing none, we're going to take a roll call vote on approval of the agenda with the amendment to move 7 between 4 and 5.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Prost. Yes. Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Fred Summer. Yes. 9 in the affirmative. Motion passes.
Let's move now to approval of our minutes from the April 22nd meeting.
Move that we approve the minutes as presented from the April 22nd, 2025 meeting.
Second.
A motion by member Summers, second by member Sanchez. Any discussion on the motion? Hearing none, if we could take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Prost. Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Fred Summer. Yes. 9 in the affirmative. Motion passes.
And finally, approval of our minutes from the April 30th meeting.
Approval of the minutes from April 30th, 2025 meeting.
Second.
Motion by member Summers, second by member Sanchez. Any discussion on the motion? Hearing none, if we could take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Prost. Yes. Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer? Yes. None in the affirmative, motion passes.
All right, we're gonna turn it now over to our State Investment Officer, agenda item 2A.
Thank you, Madam Chair, members of the council. I want to start by recognizing two new members of our team who are starting their first day with us today. Start with Kevin Dominguez over here on the end. He is starting as our HR manager today, and he comes from the private sector with some great experience. I think he's going to be a fantastic addition to our team. And then also we have Keith Flynn over here, who is starting as our private equity analyst. It's going to be fantastic to get some additional bandwidth on that team. We know that's one of the areas where we are behind our targets, behind our pacing targets, trying to get money out. And he comes with experience in the field as well. Local New Mexican, really happy to have him on our team as well. So thank you both. We are in the process of working with the governor's office to finalizing moving members of our team over to the new exempt pay bands that were authorized in the March meeting. Hopefully have that done this pay period. We had been tentatively targeting last pay period, couldn't quite get it done. They're still processing all the paperwork, but hopefully have that done this pay period. Again, just want to thank the council again for the work that you all did to authorize that, because it really is going to enable us to be more competitive with our public fund peers and allow us to staff up so that we hopefully will not continue to have over twice the median of our peers in terms of dollars managed by each individual person, because as you know, right now each member of our investment team is responsible for over $4 billion. So we're really trying to get down closer to the median of our peers of about $2 billion. I want to note that I'll be meeting very soon with the Economic Development Department to explore some of the new funding they got out of this legislative session. Specifically, I want to highlight a couple of things. They got an $11 million appropriation for recruitment and retention of talent. This is something I've never seen before. This is also something that's been discussed by the council in relation to some of the federal cuts that are happening, whether there's a way that we could try to entice some really experienced experts around the country to move to New Mexico. So I'm curious to see what the Economic Development Department is planning to do with that funding. And as well, they got tens of millions of dollars in funding for business incubators, innovation hubs, and venture studios. So I want to talk to them in particular about that. It's possible that some of our VC fund partners may be able to either directly apply for that, some of that funding, or collaborate with others who would apply for it. We are also working with Roadrunner Venture Studios and the Economic Development Department to partner on events for the upcoming Roadrunner Tech Forum this fall. It's going to be on and around October 15th. Fantastic event if you're able to attend. And finally, I want to end on a sad note. Amy Ridge, we have loved working with her during her time at Mercer. She's been a fantastic partner for us, but unfortunately she's going to be leaving Mercer. And Madam Chair, if it's okay with you, I'd like to turn it over to Amy to make a few comments. But we really want to thank Amy for all of the fantastic work she's done for us.
I just want to say thank you. It's been an absolute pleasure. I've been here many years with Richard. You're a good hand. We have my replacement here today, taking some time off to spend with the family. So looking forward to that. But thank you all so much, and it has been an absolute pleasure working with you all.
And Amy, I just want to make note that if we ever have the chance to work with you again, we would very much love to do that.
Thank you very much for asking that.
Also, just want to note for all the members who are here, we do have snacks, sodas, coffee, and water if you need anything over there. But with that, Madam Chair, I'm happy to answer any questions.
Questions for our state investment? Hearing.
Where do you see oil revenues?
But, Member Summer, I would actually turn that over to our oil and gas expert, Don Iglesias.
Hi, Mr. Would you mind repeating that question?
Where do you see oil revenues going in the foreseeable future, next 7 months?
So we have a whole presentation on that later in the agenda, but I would say for the next 7 or 8 months, we're still expecting the revenues to be relatively strong. A lot of the, for current year production, for like fiscal year 25, on which our revenues for the Early Childhood Fund and the new Severance Tax Permanent Fund distribution, those revenues have already fairly much come in the door already. And so we expect relatively the large distributions we were already expecting. We think oil prices are gonna be subdued in the future. We're estimating around $60, but even at $60, we're anticipating still to have growth within New Mexico of production, just at a slower rate than what we previously anticipated. So we'll actually have a full presentation for you, but we still expect revenues to be relatively strong, though declining over time, in the longer term, but in the near term, I expect them to hold up more or less.
Thank you. Thank you.
Madam Chair, on that point, is that presentation today? And will that also include the new act that went into effect in 2024? The new act? Yes.
Royalty Resiliency Act.
Yes. I deal with Secretary Croft, to discuss it, because that's a critical aspect of the decline in oil and gas overall, so Secretary Croft.
I'm no expert on the Royalty Resiliency Act, but it's something that's been brought to our attention in the past, during 2024, I believe. There's an issue with some backlogs processing, leasing permits, as I understand it, by BLM, that could potentially have an impact on the state's revenue in a short period, hopefully a short period of time, but I think that's what Madam Treasurer is talking about.
Yes, I'm well aware of the Royalty Resiliency Act. I'm happy to include a brief discussion of the conversations that I've had so far with LFC and what we're aware of right now and the potential impact we think that could or could not have. But I'll be sure to include that.
Okay, hearing nothing further, we're gonna head to agenda item 2B and hear from the Chief Investment Officer.
Very good. Thank you, Madam Chair, and good morning, everyone. Just a lot going on, as you've noticed, when you read the newspaper and turn on television. But as I remarked at the March meeting, much of it is just noise. But now markets process both noise and signals, so we have lots of volatility. But not a lot really happening at the basic fundamental level that either causes a lot of concern or gives us a lot of optimism anyway, because prices are still very high across many of our risk assets. There really hasn't been much for us to do in the portfolio, a little bit of rebalancing the last couple of months. We actually made a pretty good bond sale down around 4.20 on the 10-year, raised some liquidity in the rebalancing. So that was a good price for us, but not a lot of activity in the portfolio other than just trying to maintain liquidity for our increase in capital calls, which we've talked about the past few months. Rates are up, which really is having the effect of allowing the Fed to feel less pressure to cut interest rates. So we've got inflation down, it's falling below 3% now on the run rate. And with these higher interest rates further out on the curve, there's just a little bit less pressure on the Fed to cut and be able to control that inflation and make sure it stays down. Last couple things I'll mention is the annual investment plan. We're almost finished with that. We're rearranging a little bit the macro outlook section, so there'll be a little bit more information in there. In the past, we've tried to keep that to just discussing growth, inflation, and interest rates, but we're going to broaden that out just a little bit to get some more info in there. There's just so much happening right now. I feel like we should address that. And then on your agenda today, we've got 2 items of particular note. Well, 3 really. The inflows analysis, you all are always interested in that. We'll show you what we call our black dot peer analysis. We show you that every year to show you our positioning relative to other public funds. We've got, I think, 35 other funds in that chart. It really just shows you how much investment risk we're taking on a model basis relative to them and what we expect our returns to be in the long run, particularly versus these other funds. So you'll find us where you normally find us, fairly far out on the risk curve with higher return expectations than most in that group. And the last one is we've got some interim asset allocation target changes for the 3 big funds, land grant, severance, and the ECE. We've just made some good progress on the private investment side, and we're able to make some adjustments to those interims. Still working working our way toward it, still have plans, to pace to it over the next 3 to 5 years. Next month, we'll be in front of you with some ideas about how to get there a little bit quicker using some public market strategies we've been searching for the last 4 or 5 months now. So hopefully you'll find that presentation interesting, and we'll be looking for some feedback on where to go forward with that. And with that, Madam Chair, that concludes my presentation, and I'll take any questions.
Turn it over to, RUT and, no? Agenda item 2.
Morning. I'd just like to make a few comments before turning it over to Artie Coons. As we've discussed the last few months, we've been working very closely with them on improving performance. We've made meaningful changes to this month's report. Major themes are focusing on net performance, as well as reducing redundancies and trying to keep the volume of the report down to a manageable size. We'll continue to work together to make changes. You'll see with this report a lot of the main comments has been moved to the appendix, so the appendix is a little bit bigger than normal. What we wanted to do is do this in a thoughtful way so that, you know, something was, rather than just go in and delete, you know, sections and things like that, we wanted to move it over to the appendix so that, you know, you all would be able to see the changes that were being made, and if there's something that, you know, analysis that you feel strongly about, you know, let us know, and we can certainly talk about, you know, moving that back into the report. With that, I'll pass it over to Artie.
Great. Yeah, thank you very much, and good morning, everyone. You do have your first quarter executive summary that is revamped in an effort, as Nino stated, and it was really a collaboration. There's others, Don and other folks that contributed to this. This is obviously your report, so if you ever have feedback in terms of how to make this more reader-friendly, more informative, please always reach out and let us know. And we also made an effort, of course, not to remove any information, really just a reorganization of the data to hopefully facilitate your review. So as always, we'll start with a brief overview of the capital markets. Lindsay provided, I think, a good sense, but we'll try to tie it into the performance that you see, and then Marcia will give you some of the overarching changes to the layout and discuss those as we review the performance. Page 24 here, for those following along online, that's our standard capital market review page. Of course, there is a much more extensive deck behind that if you're ever interested in digging into those markets a bit more comprehensively. But here we have the economic indicators as well as the performance on the bottom left-hand side. The year started off quite well, particularly for risk assets, but then as we were getting into March, had a bit of a sell-off, of course. A lot of that was tied to news around tariffs, uncertainty that was brought along with that, and of course weakening sentiment both on the business side as well as for consumer confidence. You can see that the quarter, and most of that again happened in March, was negative for the two U.S. equity indices and positive for most of the other indices. And the concern around tariffs, some of the other items that Vince mentioned that like we've seen in the press was really around reduction in growth. So tariffs, what would that do to GDP? What might that do to inflation? So just a lot of uncertainty. And of course the news in terms of implementation and the magnitude of those measures is changing. Seems like daily now, perhaps weekly. So there's a lot of uncertainty, and that's you're starting to see priced into the market, particularly domestically. And so for a diversified investor like yourself that has a global public equity portfolio, you of course sustained that type of market environment quite well. Those that have looked back and only saw 15 years of great performance for the S&P 500, they're not looking quite as strong this year, of course, when you're comparing that just on a first quarter basis. And a lot of those trends have actually continued into the second quarter, and I'll speak to that in just a moment. When you're looking at outside of the U.S., and much of that was driven by a softening dollar, a weakening dollar, that you can see there. We have that under the economic indicator, third from the bottom, USD total weighted index. You can see that that's moved down a bit, and certainly over the last few years, that's been a tailwind for all non-U.S. investments, but particularly non-U.S. equities. Fixed income, we've seen rates move, and this is through, again, this is the Treasury yield curve at different points in time. You can see the blue and the green. Blue represents the end of year 2024. The green is March 2025, so that quarter difference, and you can see that yield curves have moved down and steepened a bit. So that led to some mixed results overall, but the broad fixed income market moved higher. You can see a return there of 2.8 for the quarter. We saw spreads widen within the credit markets. They've been reasonably tight, and so in lockstep with the sell-off in the equity markets, you saw those spreads widen a little bit. But I would note that both of your public and private debt portfolios, which tend to be very complementary, have done well in this environment. So I think you have it structured quite well for these environments. And this is the kind of environment I think that Vince has been communicating through the annual investment plan, and you've been anticipating for quite some time, and you've been well positioned to move through it. I said most of the trends have continued. I know end of first quarter probably feels like a long time ago, so just to bring you current, year to date through the close of last week, the S&P 500, so large cap is flat, gained up a little bit there. Developed non-U.S. equity is up 15%, so built on those earlier gains that you saw there. Emerging markets up 9.5%, and fixed income is up 1.5%. So non-U.S. equity is really the place to be so far this year. So I'll stop here and have Marshall walk you through some of the portfolio highlights.
No, let's take questions at the end. Okay, good. So, taking you to page 3, I just want to mention again, it was great to work with Nino and Don and Joel on this report, but it is a report, so feedback, please, as Matthias and Nino said, we welcome your feedback. Structure of the report is very similar as before. It's really focusing first on the biggest drivers of return. So we look at asset allocation first, then we look at asset classes, and then lastly, managers, which is how it was structured before. Just consolidated more. So if we go to page 3, we begin looking at each of the funds, asset allocations versus their targets. And this is now ordered. I believe this was the treasurer's idea to order by size of fund. So it's not by when the fund came into existence, but the size of the fund. So at the top, you can see land grant, followed by severance tax, and then early childhood. Later today, as Vince mentioned, and Mihail will be going over, there's going to be a change in interim targets. So the 3 funds that do have interim targets are those 3 funds. So those will be discussed. So we will continue to show interim targets into the future, but those will change after beginning, that would be beginning June 1st. Well, if you go to page 26, there's another fund, tax stabilization, that has an interim target, but if you look at the current allocation and the long-term target, you'll see that they are at target now, so that'll be addressed later today as well. So these first several pages are, again, looking at market value, where the current allocation is, and where you are versus your target, whether it be long-term or interim. The next section of the report, going to page 29 of your board report, looks at the performance. We focused in the last report mostly on land grant and severance. Now we're showing the performance, annualized performance, and a few years' performance for all of the funds, again, by size of funds, so beginning with the land grant and then workforce development, which is a newer fund at the end, and you can, so for example, land grant was up 0.94 for the quarter, which is the calendar year to date, since this report is through March, and severance tax was at 0.8, and then early childhood was at 1.09, and all of these returns are shown at the fee. The difference in some of the funds that you'll see, for example, tax stabilization, did better for the quarter. Why did it do better? Well, it's all fixed income. It's fixed income and real estate. So no public equities to drag it down for the quarter. So that explains some of the returns. So it's differing asset allocations. On page 9, this page was restructured. This is looking at calendar year to date. In this example, it's 1 quarter, but we look at beginning value and we look at ending value. In between, we always showed net cash flow and gain and loss. Now, if you look at the third column, we're showing contributions and then following that distribution. Those are the numbers that make the net cash flow. So we're giving you more detail about what came in as contributions and what was paid out, to give staff wanted that detail in there, and I think it's quite helpful to show instead of just net cash flow what that actually means. Page 32 and 33 are looking just at land grant, and then following page severance. And again, your objective is not to outperform your peers, and in this case, it's just not sovereign wealth funds. When we say land grant on page 32 versus peers, just a reminder, it's all public plans, and that includes pension plans and sovereign wealth funds. So the universe for land grant, what we show is the greater than $1 billion, and you can see the population there over 100. In each time period shown, with the exception of the 5-year, land grant has been above median. For the 5-year, it was below median, but for each annualized time period through 10 years, above median. For the 10-year, you're in the top 34th percentile, so almost top third. For the quarter, you were in the top quartile compared to other peers in this universe. And then,
And Marcia, if you don't mind, making a comment.
anytime.
So this is something that, going forward, we're gonna be looking at is perhaps taking a look at the peer group and making sure that it is representative of, the SIC and our organization and our mission and our goals and objectives. One of the things that we'll be looking at is the inclusion of endowments and foundations. And so folks who have a similar risk profile to ourselves, looking to perhaps incorporate them so that we can have a larger, sample population.
Same information is on severance. Page 34 is similar information that we've shown in the past, the risk return on the top left-hand side for the 5-year. The green and yellow on top of each other is land grant and the land grant policy index. No change from prior years, where you have about median return that's well below median volatility. The blue and orange is looking at the severance tax, and as you know, similar volatility, but a lower return for reasons that we've discussed. At the bottom of that page, to make it clear, we've included what this universe, where you rank with each asset class as far as exposure, compared to other participants in this universe. So, for example, looking at U.S. equity, you have less U.S. equities than many of the peers in this universe for U.S. equity. But next to that global ex-U.S., which is non-U.S. equity, you have a higher allocation to non-U.S. equities in your portfolio than many of your peers, and that was quite helpful for the first quarter of 2025. And then last, and before we get to the appendix, is looking at asset class performance. This is not changed, it's just, moved back a little bit. So we show each asset class and how it performed for the quarter through the 10-year period, or as long as the information we have. U.S. equity, Greg is going to be talking about that today, and the asset class exposure, and how he envisions repositioning that portfolio. You've gone through asset class structure for non-U.S. equity. Non-U.S. equity has always been a good performer for you, and you see each time period, annualized time period, had outperformance. And you can go down, these are all on the first page, all the public asset classes. Your public fixed income had, in the past, having a shorter duration exposure helped in this quarter. It did not, but you can see outperformance longer term there. And then on the next page, page 36, this is looking at more of your private, private asset class exposure. You have your specialty consultants here that are going to go through that, so I wasn't going to spend time on that, but because we're going to be talking about the severance tax and a slight change in allocation, I wanted to focus on the very bottom of that page where it talks about economically targeted investments. Don is going to be talking about the severance tax permanent fund, again, like I said, with a slight allocation change. The economically targeted is made up of the business investment corporations, so SIC, and also the recovery loan program. That is in the severance tax portfolio. If you look at economically targeted to the total portfolio, it's only 0.5%, but it's around 3% for severance tax. I want to show that these are loans. Benchmark there is just cash, T-bills, invested cash, and you can see that it has underperformed that benchmark. Just wanted to point out the long-term returns there have been negative in each annualized time period shown, and underperforming the benchmark. In the appendix is, I just want to point you to page 39. You're going to be seeing this page a lot. We showed it in the asset allocation. Funds have been grouped by highest growth to lowest growth because each of these funds have different objectives and each different cash needs. So we're trying to show this from high growth to more preservation focused, and we think this is very helpful. And then if you want to see individual managers, that's been put to the appendix. Also attributions, and then some structure for the public asset classes, public U.S., public non-U.S., and fixed income are also in the appendix. With that, we'll take any questions you may have, and again, we welcome your feedback on the report, and thank Don, Nino, and Joel for their great support in putting this report together. I will mention that when Nino said at this meeting last month that if we would have this report in a new format, I kind of, my mouth fell open, but we made it, so.
We appreciate it. I like the reorg. I think it like draws your attention to, because there's less info up front, draws your attention to certain numbers, and thank you.
Good.
Yeah, I like it.
Yeah, one of the things, we're striving for consistency here, so everything is reported net, whereas previously it was just the private asset classes, they were reported net, and then the publics would be on a gross basis and on a net basis. So we have that consistency there, and then the other thing that we're looking to do is to have these quarterly reports focus on the aggregate portfolio and have the monthly reports be a focus on the public asset classes and allow for a deeper dive into those, similar to what our consultants do on the private side. So that's our plan going forward.
So we'll break those out at some point, like the similar way that we do these?
We certainly could, and we're open to your feedback on it.
Well, when you say that we're going to do a deep dive, how will that be done?
Oh, we would have public market specific analytics.
Just within the RBK report?
Right, just on the monthly basis.
On a monthly basis.
Yeah. So things that are attributable to public asset classes specifically, and not necessarily relevant for the aggregate portfolio. So for example, on public equity, we could look at a variety of different exposures, and some of these are in here already, but looking at things like, you know, sector and market cap and geography and currency and things like that. And then even on the public debt side, we could be looking at, you know, some other things as well. Looking at maturity schedules, we could be looking at, you know, different matrices with credit ratings, things like that. We could also take a look at certain yield curve scenarios, things like that. Yeah. So this way, intra-quarter, you know, there isn't a lack
wall of information.
Right, and particularly given, you know, the volatility that we've seen in the markets, we think it's, you know, appropriate that we update you intra-quarter. And so that's what we have, is we have the public market. So why not focus on those and do a deeper dive and provide more, you know, more relevant information.
So I do appreciate you taking those things into consideration. I think highest and lowest makes sense for us to look at it. And doing the growth from highest to lowest helps us when we're reevaluating asset applications. What was removed?
So the items that were removed, other than redundancies, so things that, you know, essentially we were, you know, restating multiple times, the other items are all in the appendix.
Except for the growth of fees performance, there's no.
Oh, and so our plan with fees is to give them the attention that they deserve. And so what we're looking to do is an annual comprehensive focus on fees, and we'll do it across all of our asset classes, both public and private. And we'll be taking a look at, you know, management fees, fund expenses, as well as performance fees.
You do have the schedule, so on page 6,
We do.
have taken that off. That's in the appendix, so. Just found it. So that was one of the things I knew I felt I was missing. I feel like I'm missing something else, so I'll reevaluate what we had before,
Okay.
see if it duplicates. But I definitely appreciate an annual fee breakdown, but I still want to see the quarterly on the fees. So let's keep it in there. And then the other thing that I think is really important is when we're looking at the individual months and the different asset classes, the breakdown within that asset class, like how we've changed now in the policy infrastructure and what that looks like, just so we have a better idea on the percentages. And then on the quarterly, I don't know how this would work for you all, but I always want to keep it thoughtful of overall what that portfolio looks like. So I think, you know, you mentioned something about adding like people or entities that have the same value, sort of like on different endowments and what that looks like. When you say that triggered a different word. It meant something different to me, what that value is for New Mexicans or for our state. And so somehow I want to make sure that we're still, as a council, evaluating how does the portfolio switch or shift in the percentages of diversity, equity, and inclusion. How are we aligning with our fiduciary responsibility and at the same time making sure that the portfolio looks and fills the values of New Mexicans? And so I don't know exactly how you might put that in a 3-month report, but I would like to see the percentages to show the growth of how much we've diversified and how much we've shifted the portfolio in the asset class, and then within the fund managers and et cetera. Oh, yeah. Anyone further? Folks online have questions for RVK or Mr. Carbonino? All right, great job. I mean, you know, we put him in charge now, like you guys are, I guess, more work, but I appreciate it.
So it's working collaboratively with them and of course with Don and Joel has been great.
Good. All right, we're going to move on now to hear about inflows and total fund growth update, agenda item 2D.
Thank you, Madam Chair, council members. We will be on page 60 of your diligence report. And from there, if it's all right, I'll be referring to the page numbers at the top right-hand corner of this particular report when I go through. So just quickly, starting on page 2, here's an outline of the process flow chart so you can see how inflows help inform our overall decision-making. As you see in the light blue boxes here, oil and gas revenues do, of course, inform the inflows that we get, along with the rules and statutes that set how each of our funds get those inflows for each of the particular funding source, and that is one additional contributor to our total net asset growth. The other, of course, as you can see in the other dark blue boxes ahead of this total asset growth, is, of course, the long-term expected return, which is dictated by your strategic asset allocation and the capital market assumptions from RVK. That total net asset growth contributes then into how much we think we should be pacing in order to meet that strategic target asset allocation. And you'll be receiving a pacing update in the next, if not next month, then very soon. It's part of the annual investment plan to see how we are getting toward that strategic asset allocation. But inflows is an important part of understanding how our funds grow and how much we expect them to grow in the near and long term. Turning to page 3, we have a summary of the fund inflows since 2019, which is when the significant amount of our growth began. 2019 is the first year that we began receiving additional funds. That was the first year for the tax stabilization reserve and the Rural Library Fund, and since then we've only grown in both the number of funds and the total size of assets. And that significant amount of growth, I can remind you, in 2019 our total NAV was roughly 27 billion or so. And if you look at this chart here, in 2022, 23, and 24, in those 3 years alone, our total net receipts have been $22 billion in inflows. And this breaks down each individual fund, and you can see where that value has come from, both through the addition of new funds and the rules that provide funds to, provide dollars into the funds that were existing. Now, consistent with our expectations for 2025, we do expect those inflows to be slowing down as we move forward, but still very strong compared to historical standards. We are on track to receive over $4 billion this year. You'll see on the line items, we're still looking at over $2 billion for the calendar year for the land grant fund. We're estimating a roughly $750 million for the severance tax fund. We'll see how much that may or may not change once we get the bonding fund distribution at the end of June. Along with that, just speaking of the bonding fund, you'll notice down here for the Capital Development Reserve Fund, $82 million. That is also dollars that will come from the bonding fund, from the legislature's decision to cap its own bonding capacity to its median state debt ratios. And so whatever amount that could have been bonded against, but isn't going to be, because that would push us above median state debt ratios. What will happen instead is that funding will be issued as notes, and those dollars will then flow into the capital fund, and whatever amount that is an amount that will continue on for 10 years. I'll go into a little bit more detail on that. But essentially, it's the debt service payment that would have been paid had we issued 10-year bonds. And so that amount, currently estimated at $82 million by the Board of Finance in the legislative session, we'll hopefully be getting an update soon once we know what actual revenues into the bonding fund have been we'll finalize the year at. But that amount, whatever it ends up settling on, will then be that same amount every year for 10 years. And that's essentially the debt service savings that will start flowing into this Capital Development Reserve Fund. Now, starting the next year, if there is still additional savings from revenue coming in the door and those state cap debt ratios, then it will happen again. There will be another 10-year set amount. So there is significant potential for this fund to grow. Again, I'll go into a little more detail, but I did want to point that out, that in June should be our first distribution for the Capital Development Reserve Fund. This $82 million is an estimate. We'll see what it ends up actually being next month. For the Early Childhood Education and Care Fund, we're expecting $1.1 billion. This 2025 estimate is from fiscal year 2025 excess over the 5-year average. As you know, since we are currently Not only are we in May of the fiscal year, but because our revenues are on a 3-month lag, the fiscal year in terms of production for New Mexico is actually complete. So that 1.1 billion is fairly set, shouldn't change too much because those dollars have already come into the door. That production through roughly March has already occurred, and so we'll be seeing those revenues come in. We know what the 5-year average is, so that 1.1 billion shouldn't change very much. But I will go into a little more detail on Secretary Montoya's, Treasurer Montoya's question on federal royalty payments. Not a lot of other inflows expected. You'll notice here on this chart, we've added the 2 new funds that the legislature has added, the Behavioral Health Trust Fund and the Medicaid Trust Fund. And I'll go into a discussion on that here if we turn to page 5. 4 and 5 is just the outline of how each of our funds get revenues. This description has not changed, with the exception of adding in the Behavioral Health Trust Fund and the Medicaid Trust Fund. So, as you all know, the Behavioral Health Trust Fund was seeded with a $100 million appropriation, so we should be receiving that in July. Those dollars are guaranteed to come into the door. There were also some behavioral health specific one-time appropriations that were made in the House Bill 2 for 2025. Reversions from those, whenever they come in, could also flow into this Behavioral Health Trust Fund for any unspent dollars from those appropriations. So it's another way that fund can receive funding. And the final way is it will receive 50% of the oil and gas emergency school tax revenue for 3 years, from FY26 to FY28. Now, you'll recall the school tax, along with the federal royalty payments, is how the Early Childhood Trust Fund has been getting money. And so what happens now currently is anything over the 5-year average for school tax or federal mineral leasing payments all flows into the Early Childhood Fund. And what the legislature said is for FY26 to FY28, whatever that amount is, half of it should go into these 2 new funds instead. So half of the school tax amount will go into the Behavioral Health Trust Fund, half of the federal royalty payment amount will go into the new Medicaid Trust Fund. Now, for the Medicaid Trust Fund, it was not seeded with an initial appropriation. So it will rely only on the mechanisms that were created in statute for it to get funding. It will have no seed or endowment amount from the legislature. It didn't get an appropriation. Now, there's 2 primary ways it gets money. One I just described, the 3 years of potential excess oil and gas payments, half of whatever the Early Childhood Fund would have received or will receive. And then the other part is state agency budget reversion. So as you all know, most state agency reversions, unless there's some sort of carve out in law, they just go into the general fund. So whatever gets reverted from unspent budget dollars from all state agencies. And what this bill said is any of those state agency reversions above $110 million. So $110 million definitely going into the general fund. Anything that gets reverted above that amount is all going to go into this Medicaid fund. And that will continue to occur until the Medicaid fund is at least $2 billion. So however long that takes, that mechanism will be in place. The current consensus revenue estimate projects $110 million for state agency reversions. That number is always unknown, though. We have no idea what agencies will spend and will ultimately revert. So the current projection is nothing from that, but it could potentially be tens or hundreds of millions of dollars if the past 2 or 3 years of budget reversions is any indicator. It could be large, but it's almost impossible to estimate, and we'll just have to see at the end of the year what agencies end up not spending from their budgets and then reverting and will come into this fund. Turning on to page 6. This is to better illustrate how the mechanism for distributing funding from oil and gas school tax and federal mineral leasing works, because there's a couple things that we've just discussed that will be occurring from these payments. So the legislature has taken these 2 single sources of revenue, has divvied them up in several different ways. So the historical application of this is anything over the 5-year average. goes into the Early Childhood Fund. You can see those very large light blue bars. Those are the distributions that have already occurred, those excesses over the 5-year average. The dark blue bars is that 5-year average that's been going into the general fund. And then you'll see starting in FY24, the legislature made a decision and said we want to keep general fund revenue from these two sources at what that 5-year average was at FY24. So that's what the general fund will continue to get. So now we have two conditions. Anything over the 5-year average still goes into the Early Childhood Trust Fund, with the exception of the next 3 years. Half of that is going to now go into the Behavioral Health or Medicaid Fund. And then that difference between that 5-year average and the FY24 tax amount, those yellow bars, that's the new money that will be flowing into the Severance Tax Permanent Fund. We will be receiving our very first distribution from this mechanism for fiscal year 25. That distribution will occur later this year. Once the books have closed, all of those revenues have been received. DFA typically distributes the school tax dollars in December after the audit, generally distributes the federal royalty dollars roughly September, October-ish. You'll notice potentially some very small bars on this FY26. There's a green and a purple there. What that is half of the expected amount above the 5-year average for school tax and federal royalty. So the 3 years that the legislature has chosen for half of those dollars to go into these two new funds, what we're currently expecting is that by then, the 5-year average will have already pretty much caught up with how total revenues are coming into the door, which means there isn't going to be a lot over the 5-year average unless there is some sort of very large commodity price spike that sends oil prices to $100 or natural gas prices to $7. Then that could shoot up revenues. We could see very large numbers above that 5-year average, and these funds would benefit from that. But unless that occurs, we actually think those distributions into the two new funds will be relatively small for FY26, and we're currently, under our estimate, not expecting there to be anything above the 5-year average in 27 or 28. Now again, prices are volatile, but the current expectation is that it's unlikely to receive very significant dollars, absent some sort of change in the market. This is probably a good time to kind of pause here. I don't have a slide on this, but I do want to address Treasurer Montoya's question on the Royalty Resiliency Act. So this is a conversation that we have been having with the Legislative Finance Committee. I know LFC has been very much in touch with DFA and with TRD. We're all trying to wrap our heads around what the implications of this new act could be for revenues coming in the door. So I'm going to do my best to explain what it even is and how we think it may or potentially may not affect federal royalty revenues for the state. So communitization agreements are agreements that occur for oil and gas producers, whose production spans different land types. So whether it's federal, state, private, Indian land, they will provide communitization agreements that basically say, here is how much percentage-wise our production is occurring on state land versus federal land, which is primarily what we have in Eddy and Lee County, small amounts of private or Indian land. So those communitization agreements is how they allocate their dollars. However, the federal government, prior to the Royalty Resiliency Act, the federal government would say, it doesn't matter what you think those allocations are going to be. Whenever you submit your application and you start paying royalty dollars on that production, until that agreement is approved, you're going to pay the federal government as if it's 100%. It's not going to matter if it could be 1%, it could be 99%. You have to pay the federal government as if it's 100% of that money comes into for federal royalties. And then the law says there's 120 days that the government has to approve that communitization agreement, and then the operator can recoup whatever amount it had overpaid to the federal government to be paid back to it. So in practice, this has been happening already. That is how this function has worked. The operator would pay the federal government for all of the production that they said was going to be split between state and federal lands, and those operators would recoup those dollars as it has been approved. The state has already been experiencing those recoupments, but at the pace of approvals. So it's been baked into our federal tree royalty distributions over the past several years. The change is that the Royalty Resiliency Act now says operators can just start paying based on whatever they filed their application for that allocation amount to be. So the federal government still gets what it's due, the state still gets what it's due, but the operator only has to pay the amount it thinks it's owed upfront without there being an overpayment and a later recoupment. The potential for a large impact now is that leading up to this change, there had been roughly 12 to 18 months of a backlog of communitization agreements that still needed to be approved by the federal government. And supposedly, there is a push now to try to clear all of those off the books very quickly so that we can just move into this new system of operators only paying what is owed to each state or federal government. The potential impact for that is that you could see a lot of recoupments in a short period of time. So rather than them occurring gradually and kind of rolling on, so those dollars would sort of be extracted from the amount that the state was owed the following month, and then you would still have the amount that was paid, and it would kind of net out. Now we might see a large number of recoupments in a short period of time. And unfortunately, in conversations with the ONRR, so the Office of Natural Resource Revenue from the federal government, so conversations with BLM, they don't have a great idea of how much that's going to be. And the estimate they give us isn't particularly helpful because they said the impact could be anywhere between $0 and $1 billion. And so we're trying to put this into context to say, okay, what could these recoupments actually do? We're understanding that this is not necessarily a change. It's all what we would have seen gradually over time, but the impact could be in a one-time disbursement. And this chart kind of helps to illustrate, this is both school tax and federal royalty payments, but the shape of the chart is still very similar for federal royalty alone. So I'm going to use this chart as a way to kind of indicate what the impact could be. So if those recoupments occur at large all at once, we'll see an immediate drop in federal royalty payments. So whereas we have been seeing, say, $200 million a month come in, you could see $100 million instead, or you could see nothing because there was $200 million of recoupment that they had managed to just suddenly approve very quickly. The first thing that will be affected is the amount over the 5-year average. So that would be distributions to the Early Childhood Fund, and now the Behavioral Health and Medicaid Trust Fund. So if those recoupments are relatively large, the first thing that we see as being at risk is how much those funds will get, particularly for FY26, because again, the FY25 distributions have pretty much occurred. Those are dollars in the door. Our state calculations say it's based on those dollars received in the door between now and June 30. So if these recoupments start affecting the next few months, we'll basically be seeing an FY26 impact. And as you see, FY26, for amount over the 5-year average, is not expected to be very large. We are anticipating for the Early Childhood Fund, I have this pulled up here, roughly $200 to $250 million for FY26 is expected to come into the to be the amount over the 5-year average for federal royalty payments. Half of that would go to the Medicaid fund if it comes in, half would go to early childhood. So that would be considered an at-risk amount. If it were to hit, it will hit those distributions first. The second at-risk amount would be how much would go into the severance tax permanent fund. And that for next year, we're estimating somewhere between $500 and $600 million, depending on how oil prices fall. So the secondary impact would be distributions to the severance tax permanent fund in FY26. The final potential to fill that impact is the general fund. And the way that the general fund has set up its revenues is the general fund gets the money first. And as long as it comes to roughly half of the total amount that we're expecting for revenues to be generated for royalty payments, the general fund may not be affected, but the excess distributions to our funds might. And again, it's not that we are losing money, it's just that that settlement of revenue would occur quicker than it otherwise would, just being worked through by approval, payment, approval, and netting out. Did you have any additional questions before I move on from that, Treasurer Montoya?
Madam Chair, thank you for explaining it. I didn't have questions, I was just bringing up what Member Summers said. I think for us, it's a little different on my end because the Department of Interior met with both my office and Secretary Powell's office along with several state agencies. The amount of money that they're trying to get from the monthly distribution could make the monthly distribution potentially become a negative. And the difficulty on our end is that if that were to occur, because it's only going to be up until October, their fiscal year. So all of this happens between now and October. They have no idea how much money it was going to be each time. There was one state that had more than the negative balance at the end of the month. And New Mexico has the highest distribution in the country. And so that was why it became more of an urgent call. Because they couldn't project what the honor system is going to allow for those operators to be able to stay, which I think is ridiculous. That affects what the legislature and the governor signed off on for the budget for this. So I think for that reason, it's important. And then Dawn mentioning the side that affects the SIC is really important to look at this holistically.
And we remain in continuous conversation with both LFC and members of the Consensus Revenue Group. If we get additional information, we're happy to share it along with the council. As for now, it's almost a wait and see how it comes through. We're just waiting for those distributions to come in and see what the impact is as they happen.
So if it's a negative number, do we pay?
That is a fantastic question, and I don't think that it's been fully resolved. I'll probably defer to you, Madam Treasurer.
What we've asked is that if it's a negative number, if they hold off to the end of the end of that month, the rest of it on the next month, so that there isn't a negative number. The distribution, I was trying to get a hold of, Mark Melhoff, thing, and I couldn't remember. It was, it was, I think, $4 million per month, but it sounds low to me. But we did say that if there was a negative, if there's a potential for them to put it into the 2 different months so that it doesn't negatively impact overall. So we don't have to pay anything back. We just won't get it, but we don't have to pay it back. That's what we're looking at. But the state folks, I will say, are really on top of it. There was a big meeting with all of them, and then I called to make sure SIC wasn't on there, and I knew it affected them in a different way. So I think all of us have pretty much been on top of it, trying to make sure that we don't get negatively affected. But the difficulty is that they don't know what it's going to entail until it actually entails. So they said they'd run a report at 2 weeks out. I'm sure they have a back of the envelope number. I mean, like, our guys are involved in these comms. They know what it is.
Well, and actually, Madam Chair, I've been in conversation with Esteban Baca, the Director for the Royalty Management Division at the Land Office, because we were thinking that the Land Office obviously has a very good handle on these comms agreements, and what we've learned in that process is while these amounts for the comms agreements are still being approved, Land Office does hold those dollars in suspense, and they wait until the federal government has officially approved those comms amounts to then see what is entitled to be distributed out to the beneficiaries. And in that conversation, there was roughly 150 million or so that sort of held in suspense right now at the Land Office. The only issue is trying to extrapolate what that means, because without being able to see exactly how that 150 million translates into the comms agreement's projected amount, if you try to back end extrapolate into the value,
and then to give a range, you know, like, is it 0, is it 150?
Well, and unfortunately, their range was 0 to a billion, was the best range that BLM was able to give us. I think the billion is very conservative on their part. I think they're trying to prepare us for a worst-case scenario. One of the things that had been really encouraging in our conversations with ONRR was they've said that of the 18-month backlog, they've already cleared through 6 months. And looking at those monthly distributions for royalty payments, it didn't look all that different. Now, who knows what the next 12 months of backlog they have to get through looks like. But the encouraging part is that some of this has already been happening. We didn't see a very serious impact so far, so that's good to know. And also, the exponential rate of growth for production on federal land that we have seen, and that is tracked not just through the state-reported systems, but through our outside reported systems like Rystad Energy, as well as the Energy Information Administration, our PRD, and through MNERD. All of these sources confirm that the rate of growth of production on federal land has been very large and very consistently increasing. So there isn't necessarily a worry on our part that somehow all of these federal dollars that we have been getting, we weren't actually entitled to. Some of it could have been too large and is being corrected as the amounts flow through, but that production on federal land is definitive. And that is encouraging to say that the state will be owed a pretty big amount of federal royalty dollars. So my early guess, if I had to make one, is that their $1 billion number is them sort of throwing out a number to say if everything in the backlog is actually supposed to be 99% state land, then it could be as big as $1 billion, but I highly doubt that. If there's no other questions on the Royalty Resiliency Act, and if the council is inclined, I can also, try to ask other members of either the consensus group to come in and to present to you, or we'll certainly follow up with information as we get it. But I'll turn on to page 7. This is the total inflow outlook by fund. The shape of this will look very similar to you because our outlook, all things considered, is very similar. The last 3 years of distributions have been a relative anomaly. We expect those to start evening out in roughly that $4 billion, a little over $4 billion range of inflows per year through roughly the end of this decade before we are expecting to see a potential peak in those revenues, and then we will start entering in a period of decline unless something significant changes in the outlook. The big difference between this chart this year and what you saw last year in March is going to be the addition of those light green bars, which is for the Capital Development Reserve Fund. And this is Board of Finance's current estimation, or at least as current as January when they put this out as part of the consensus group, of what they think that limited debt capacity for the state impact will have and what those distributions into the new CDRF could be. So, like I said, it will get whatever that amount is for June 30, which they've currently estimated at $82 million. We'll see what it ends up being. But once that amount is decided, then the CDRF will get that same amount every year for 10 years, because that's the amount of debt service that would have been paid had we issued long-term bonds on the capacity. Next year, Board of Finance estimates that there will be an additional amount, and then if that amount comes to fruition, we'll get that amount every year for 10 years. And so it'll sort of grow over that 10-year period, and then they're expecting it to decline as severance tax revenues decline. The whole purpose of this was to keep the state from entering into too much debt capacity, when in the long term we would start seeing declining revenues, and then debt payments would overtake the ability to issue new bonds for infrastructure. So they're artificially limiting their debt capacity now and sending it into this fund, which can also be used for capital development projects by the rules that are set by the fund. We will continue to be in conversations with Board of Finance. Our staff is really unable to estimate what those debt capacity ratios will be. It has to do with population growth and income for the state, as well as severance tax revenues. So we get our updates from Board of Finance. I would like to thank Secretary Pross and the Board of Finance Director, Ashley Leach, who has been phenomenal in working with us and keeping us updated and informed of their latest estimates. Moving on to page 8, just a brief discussion of the production outlook for New Mexico. So as you can see, this is the Rystad Energy estimates for New Mexico oil and gas production, and the outlook is very similar from what we saw last year in that we're expecting growth for the next few years and then to enter into a period of decline as the basin itself matures, and as the energy transition takes hold. That we should start seeing peak in the Permian Basin, much like we saw peak in the North Dakota Bakken Basin. That's just a mature shale basin. We'll eventually not be able to drill enough new wells to continuously replace the decline rate of those wells. So as that basin matures, it will naturally start to decline. The only question is when that happens, and that really depends on the price of oil and how long you can entice new drilling in less advantageous parts of the rock. And at roughly $60 oil, this is roughly what we can expect. So if oil prices are at least $60 in the forward-looking outlook, we expect this to be a relatively reasonable production outlook. Rystad has come down with their expectation for this year. Since this year was last year, they thought this year would be roughly $75. They've since brought that expectation down to an average for the year of 65, which is basically 60 for the remaining portion of the year, where they're now expecting the Permian to not grow as much as it otherwise was expected to, but it is on track to still be the only basin that will actually grow. So the headlines that you've more than likely been seeing about total U.S. production could actually see year-over-year declines this year. That very well could be the case. If the Permian Basin is the only one expected to grow, and its growth will not outpace enough of the declines that you would see from other basins that can't better sustain that $60 price, then for total U.S., you would see year-over-year declines. We're still expecting limited growth in the Permian this year. We have roughly 6 to 8% currently expected. If we held flat barrels per day for the rest of this year, if we were just able to enter maintenance mode, which our break-even suggests we very well can. But if we just enter maintenance mode for the rest of the year, we will have grown 6% over production for last year. The real question will be potential growth for next year, which we're already expecting to be relatively limited, 3 to 4%. And then we are expecting within the next 3 or 4 years or so for that peak to start occurring. So the overall outlook hasn't changed that much, and a lot of that has to do with the phenomenal break-even prices that the Delaware portion of the Permian Basin specifically continues to have. I have a slide on that in here for you, as well as the fact that we already had relatively conservative estimates for our forward-looking outlook, and we did that in case we come into situations where we do now, where the outlook has changed and it doesn't change our expectations that much. Moving on to page 9 for the price outlook for WTI and Henry Hub, as you can see. So this was the light blue dotted line is futures as of May. The curve of that hasn't changed terribly. As of now, we're still sitting at $60 oil today. The futures curve, when this chart was made, was also at around $60 oil. As you're all aware, we were pretty much hovering in the mid-70s there for a while until OPEC announced that it will no longer be constraining its own production. So OPEC will begin producing more. And that announcement occurred at the same time as the tariff announcement. So there's a lot of anxiety in the oil markets, and that caused prices to briefly drop below 60. They've since recovered into around that $60 range, and 60 had been our relative long-term outlook, which last year seemed conservative, this year seems prudent. At the moment, we don't see the need to change that $60 outlook as our base case. However, I will say that there is additional pressure in the near term for potential tariff and economic impacts to spook the oil market. Potential for tariff impacts on things like freight, transportation, aviation, maritime. The extent to which tariffs can affect trade could also have an outsized effect on oil demand, and if oil demand sinks pretty significantly in response to tariffs, or even if it sinks if investors anticipate and speculate that the economy will drop, we could see some shock in those near-term prices. So even though we are expecting 60, it's still our base case for the long term, and we think long term there is support for that continued oil demand. That in the short term there could be some volatility. And just running a quick back of the napkin, we think anywhere for this year, anywhere between $300 or $400 million of total revenue coming across all our funds for the different rules could potentially be at risk if we were to, say, see $50 oil instead of $60 oil. You'll also notice sort of the conversation around the support for long-term prices. That is evident in the Rystad and the Oxford Economics price forecast. So you can see that those are still, they have a near-term dip and then continue on much above that 60. Again, 60 is what we use for our model. So anything, prices that we see above that will be upside to our forecast, and we will adjust accordingly. The next page, page 10, is just to give you that brief overview of our break-even prices to show why New Mexico is still in a good position for our current outlook. The Delaware Basin here on the far left-hand side, the average break-even price, assuming 10% returns for investors, is still slightly above $40. Now, what you can see, though, is a pretty significant range on that. So those operators that have break-evens above 50, we don't really have many in our portion of the Permian Basin who are operating above $55 break-evens, but those who are getting closer to that, to the current oil price, are more at risk. But at large, the state is still likely to continue growing, but that at-risk amount above those break-even prices is what could lead to lower growth than what we thought could happen last year. Moving on to page 11, this is just an illustration from Rystad Energy. The chart itself isn't as intuitive to determine. This is drilling across all oil plays in the U.S., and you can see drilling between 0 and 50, that line is much steeper, which means once you drop below $50 oil prices, every dollar drop below that gets you more and more production declines. You get less drilling from there. Where we expect to be in that $50 to $70 range, the Permian Basin is still expected to see moderate growth. You could see modest declines elsewhere. So for the total U.S. amount, would be roughly flat, potentially slight year-over-year negative. So if you see those headlines, this helps to illustrate why that's the case. The other thing that I would point out from here is you'll notice from $70 to $100, this is what we were talking about last year. You don't actually see a lot of growth in between those ranges. You see more potential for profits to oil companies as they engage in share buybacks and increase dividends. And that really up only $100, up over $100, do you start to see an actual incentive to drill more than they would have otherwise in their current forward guidance. Moving on to the next page, 12, is our oil production scenarios by WTI price. Rystad Energy puts these out. And again, this is to give you an idea of under these different price scenarios. We track these to see what the potential impact could be. And you'll notice their current base case isn't that different than the dashed green line, which is just flat $60. Rystad's base case is to not have flat 60. I showed you on the slide before. They're expecting prices to recover. On that recovery, these dark blue lines with yellow dots is what they're expecting for New Mexico production. But a sort of, if nothing but price matters and prices were just 60, then we would get those green dotted lines. And then you can see each other price scenario there, where for this current year, even under low prices scenario, we're still likely to see year-over-year growth from last year, but it can change again for FY26, the shape of that curve. If we were to see near-term price declines in those early years, this roughly the difference we would expect to see in production if, say, we had a price shock at $45 that then recovered to 60. What would the impact on next year be? We would expect it would look something roughly like this shape. Moving on to page 13. This is a chart of our net asset value growth and fund distribution estimates. As you can see, we are still expecting within the next 6 to 7 years to hit $100 billion if our base case scenarios are accurate. This also uses RBK's 2025 capital market assumptions and the expected compound return for those funds. So again, this is really just a guide to see where we could end up in 10 years. The individual years could look very different depending on market performance, but on a 10-year sort of long-term average, if we were to see those expected compound returns, this is roughly where we would see growth for our funds and potentially hitting $100 billion by 2031. On the right-hand side is fund distributions. In 2025, we're at $2.5 billion to be distributed this year, and we think we'll hit $3 billion in just 2 more years, so by 2027. The only thing I'll point out is this 2024, you see that spike on the gray bar. That's the distribution from the tax stabilization reserve to the new higher education trust fund. It technically counts as a distribution, but when we think about distributions to the state, we wouldn't really include that number per se because it was transferred from one account to another. And we do think that by the next 10 years, our fund distributions to various entities across the state could exceed $5 billion. So a significant impact for the state. We do have our continued scenario analyses for energy transition scenarios. These haven't really changed, and in the interest of your time, I won't go into much detail on them other than to point out that they are here. The RISAT energy scenarios described on this page essentially look at a top-down economic model that says if global warming was limited to 1.6 degrees Celsius, for example, what would need to happen in terms of reduction in supply and demand for oil products, and then if you had that reduction, what prices would necessitate that supply reduction. So in the 1.6 degree scenario, you have prices plummeting very quickly, going to $45 next year, and then quickly falling well below that over time, and you have a very sharp decline in production after that on page 16. And then in the other 2 scenarios, it's different degrees warming. I'll let you go through those. If you have any questions on them, I'm more than happy to go into additional detail. Page 17 outlines how the inflow estimates would change under these different energy transition scenarios. And then page 18 shows how NAV growth would differ under these different scenarios as well. One thing I'll point out is that even under the 1.6 degree scenario, so inflows would start declining pretty significantly. The size of our funds, the strategic asset allocations that you have all set, and the expected compound returns for those, even under that rapidly declining inflow scenario, we would still see some pretty significant growth in our funds, where by the end of the 10-year period, we could still end up around $85 billion. So still a very large fund and very large growth to consider. This is encouraging for us in terms of our pacing plans to know that even under a very low scenario for inflows, that we would still need to at least be pacing to roughly this $85 billion number. We think we're pacing closer to that $120 billion number, but this is encouraging for our scenarios so that we try our best to avoid pumping the gas too hard, and in a business scenario we don't expect. That is the end of my presentation. The last thing I'll just point out for Treasurer Montoya is on page 20. I promised the next time that I included a presentation that showed how our funds all receive revenue. I would also include a list of all the third-party client funds that we manage. None of our NAV estimates include third-party client funds. I make no attempt to estimate or project what growth of those funds would be. They're sitting at $2 billion now. So at the moment, you could take what the estimates are here and add roughly $2.5 billion, and then whatever growth that you think their asset allocations would achieve them. And with that, I'm happy to stand for any additional questions.
Madam Chair. Your estimates last year, I thought were very conservative, but you were very appreciative what you were projecting. I think you did a very good job presentation. Thank you.
Madam Chair, members of the council, Don, have you taken a look at the potential impact of the proposed reduction in the federal onshore royalty rate from roughly 6 to 12%?
Yes. Secretary Prompt, members of the council. So if you all recall, the federal government had 12.5% royalty rates for a very, very long time. Most federal land is held by production, and that during the Biden administration, when the federal government for the first time raised its royalty rates, it's been in discussion for a long time, but it had first raised its royalty rates from 12.5% to 18.75%. We actually didn't change our models, because 95+% of federal land is already held by production, which meant that it would only be brand new leases that would experience that higher federal royalty rate, and that land is unproven land, may or may not be produced on, may or may not be in exceptional areas of the basin, because exceptional areas of the basin are already leased. There was a lot of conversation at the time when that change was made on where we might see unleased land for the feds, and it was expected that that would be more of a long-term gradual increase. So instead of directly accounting for a change within our models for federal royalty payments, we instead said, okay, we'll look at the average change in royalties over time. We do something very similar with the state land office, since the royalty rates have changed over time. Some are held by production under much lower rates. We have new higher rates that are currently in place, but the long-term average is around 14.7%, and it gradually increases. And by long-term, I mean very long-term. And we gradually increase that over time as we start to see it shift up, and it has been shifting up marginally. With that being said, because we didn't expect the federal royalty change to have an immediate impact when it was increased, we likewise don't expect it to have a large impact now that it's going back to the 12.5%.
And just, on that third-party client fund, what that total amount is off the top of your head?
It will be in our performance report. I apologize. I can look that up very quickly.
Overall, for me, the point, and I wanted to make sure the council saw this, because I see some of these on the other boards I sit on, but in addition to the 14 that SIC is currently doing for us, that we're directly oversight, in addition to that is all of the ones on page 79. And that's a huge contribution to our state, to be able to have a sovereign wealth fund that is able to help those that have very little money to be able to get a pretty good rate of return, considering if they don't need the money right away. So I think it's a great resource for the long-term aspects, just similarly to the LGIP for short-term.
I did. Madam Treasurer, it is $2.486 billion as of April 30th. That's in our investment holdings report. And if anyone in the council is interested on the specific amounts for each of these client funds that are listed, that begins on page 508 of your packet.
So I would just make note for anybody who's listening in, if they have long-term funds and they qualify to work with SIC, this is a great avenue to diversify and be able to get a better rate of return for the long-term dollars. And I'm very grateful to the council that we made a decision to increase staffing, because everything that we're seeing for the most part is showing the amount of growth that we're going to need to have during this next decade.
Hold on. Oh, anyone online? So I do appreciate this report. I'm curious, did you run your projections by anyone at the land office to get further insight from them? I mean, this is literally what we do every single day.
I'm happy to share the estimates with them.
So you're not curious about their take on it?
Oh, no, I absolutely am. In preparing this, I didn't but I'm more than happy to run this by them and include any, updates or changes.
And then, have you looked at the impact on the increased royalty rate from the state plans, or?
So for ours, because it's difficult for us to know what is held under production, I know we've had conversations with land office before, but from the bill analysis, I didn't see, much change in the estimated impact that, you had for the bill analysis than was had in previous years. So that's incorporated, what was included in the fiscal impact.
The additional $45 million per year, and then, or not per year, $45 million over the life of the leases.
So we do our best to incorporate that.
Okay.
And like I said, we also look at the very long-term rate. So if anything, what we would have here would be low, and that there's potential upside for, what that impact could be. But when we run our models, we're looking at that long-term rate, and then we shift it over time. So, last year, it was, 14.6 on the high end, looking closer to 14.7. Now it's roughly 14.75. So we use that, and it just adjusts over time as it grows. So we're using, actual as it grows over time, rather than trying to make a specific determination on what that impact would be, because I'll admit I'm not the most, apt to know what that potential change is. Any additional information that the land office had and what they thought that impact would be, I would be more than happy to incorporate in our model.
Okay. So anyone curious about why that royalty rate changes? Know why that royalty rate changes, the adjusted amount? No, I know, but the effective rate, we call it the effective rate. So essentially, it's like the average rate or the adjusted rate. So it used to be that the average was low, and then over time it changes. Some of those leases are leased back out for a higher, more modern rate. And the land office for the last 6 years has actually had a laser focus on ensuring that those older leases don't just kind of languish there with, people not producing them and things. So we have been able to have the 25% is sexy and makes headlines, but our effective rate has increased in the last 6 years, maybe more so than it had ever in the past because of the work. I know, it's the kind of, the thinking goes that the land office is just there to cash the checks and hold the cash register, but we do have policy that tries to get at every last dollar that we feel beneficiaries are due. I'm glad that you're watching out for the effective rate.
Absolutely. It's a key part for our models, and we watch it continuously.
Further questions? Agenda item 2E.
Thank you, Madam Chair. Kyle's making his way up. I just want to make a couple of notes on this report. We've been producing this for you for a number of years. Really the main point is just to show you our risk profile relative to 35, this in our case, other public funds. Most of them are pensions, but they do run from pensions that are fully funded. In fact, one in there is actually over, down to funds that, are about 70%. So generally, as a sovereign wealth fund, you'd expect to see us a little further out the curve. But I think even relative to funds that don't have, the problem of underfunding, we're still fairly aggressively positioned relative to them. The primary reason that we can take that kind of investment risk is really the strength of our inflows and then the stability of our distribution relative to a lot of the other funds in there. We frequently get questions on investment risk taking, how much, and in particular questions on how much. Generally, when risk assets are doing well, particularly U.S. equities, we get questions about should we be taking more risk. Generally, when their risk assets are doing poorly, particularly U.S. equities, most of that commentary goes away. Occasionally, we'll get someone saying it's good that you guys are positioned the way you are. This is more than just producing this report, at least the benefit for our adequate report, but we do a lot of homogenization with allocations to get them into some standard buckets. That leads us to do research on what other funds are doing outside of sort of standard asset allocations. So we learn a lot about what others are doing. Sometimes we find things we're interested in and we pursue a little bit further. Most of the time we find things that we've either tried in the past and moved away from or never really got into, and we're happy that we did not. And also we look for particularly good or particularly poor asset class performances to see what other funds are doing right within their asset classes to generate returns, and others, when they've done a little bit more poorly, what happened in that case. So going through the process is at least as valuable as the end result, the report. So lots of work go into this. Kyle's going to brief you on the results and take any questions from both of you and I.
Thank you, Vince. Good morning, council members. So, as Vince has alluded to, we've been pretty consistent in terms of the peer group size. We've been tracking the same 35 peer organizations over the last 3 years. Now, most of those organizations are public pension plans, so I would like to ask you to keep that in mind because that's going to come up later in the analysis. And all of the data came from June 30, 2024 annual financial reports, with a couple of exceptions, as there were a couple of organizations reporting either at the end of the calendar year or September, August timeframe. So let's get into the analysis itself. If you go to page 83 of your due diligence materials, just a quick reminder, the green line, the efficient frontier, it's a graphical representation in modern portfolio theory that shows the set of portfolios offering either the highest level of return for a given level of risk or the lowest risk for a given level of expected return, depending on how you look at that. The green, orange, and blue diamond shapes are land grant, severance tax, and early childhood permanent funds, respectively. Those three permanent funds account for about 89% of portfolio value, so statistically speaking, those three funds are representative of the total portfolio. We also included for illustrative purposes the 70-30 portfolio, which is 70% public equity, 30% fixed income, and the average portfolio represented by the purple dot in the chart. So what does the chart show itself? We can see that the land grant is located in the upper right-hand corner. That means that we are fairly compensated for the level of risk that we are taking. Now, we also included the 2020 portfolio that was constructed by applying this year's 2025 long-term capital market assumptions to the 2020 long-term targets that we had for the land grant. And you can see it's a gray diamond shape, fairly close to the efficient frontier. So compared to 2020 portfolio, we see the move closer to the efficient frontier and more to that upper right-hand corner. That can be explained primarily by the fact that we have reallocated 4% of portfolio value from public fixed income to private equity. So a more risky and more higher return in asset class, and you have that diagonal move to the upper right-hand corner of the chart. Early childhood and severance tax, the orange and the blue diamond shapes, you can see that they are located on top of that main cluster of peers, and they are efficiently allocated compared to the peer group itself. Now let me quickly walk you through the asset class breakdown. So if we go to page 85, as far as the public equities are concerned, we are around the median for, for U.S. equity allocations, and we are in top quartile for international equity. Next, page 86, in terms of fixed income, we are in the bottom quartile for core fixed income and top quartile for non-core fixed income. As I mentioned before, most of the peers are public pension plans, and they have historically been overly allocated into the core fixed income, so that explains our position as a little bit underweight to the median. What is interesting is the last page, page 87. So that's the analysis for the alternatives for all of the private asset classes that we invested in. So what is not surprising is the fact that we are in top quartile in terms of real assets and real estate allocations. But what is actually surprising is the fact that we are at or below the median for the private equity allocations. Now, I have mentioned that before, public pension plans, they are historically more predisposed to invest in core fixed income, and most of the time they are slightly underweight most of the private asset classes, including private equity. But that data clearly shows that we are not even top quartile in terms of private equity allocations. I took a look at all of the peers, 35 organizations, and I found out that over the last 3 years, 27 of them, which is about 77%, they increased their allocation to private equity by an average of 4.1% per year. I'll leave you with that observation and pass it on to Matthias from RBK for additional comments.
Thank you, Mihail. I think you covered it well. Overall, you're well positioned. I think you're taking some thoughtful risk in the portfolio, given your overall cash flow profile that Vince mentioned. You have a lot of wind at your back that most other, particularly pension plans, don't have. Your distribution policy is more akin to endowments and foundations, and that really ties into Nino's comments about seeing if we can add some endowments and foundations to your peer group analysis for comparison, given the similarities in terms of the investment objectives, the target return, but also the lack of restrictions that you have in particular, which provides you a tremendous amount of freedom. So we think you're allocated well. We're seeing overall, year over year, not too many changes, but the market continues to right-size their return expectations. So particularly in the pension world, we're seeing assumed rate of returns coming down in terms of what they anticipate those assets to earn. Whereas you've maintained, I think, a more realistic target return for a longer period of time, where the peer group has come down to where you are. And relative to the average or median in this group, you would be expected to outperform that on a risk-adjusted basis by about 60 basis over the long term.
You mentioned, but surprisingly, why was that surprisingly?
Just historical precedent. Over the last 10 to 15 years, the public pension plans have a tendency of under-allocating in the private asset classes, and private equity being one of the riskier asset classes. That was not usually the place where those institutions would like to park their money in. But over the last 3 years, and that's a small sample, right? 35, and we have thousands of those organizations. Just being able to see that 4.1% growth in allocations to private equity over the last 3 years alone, that was a little bit surprising in the sense that we are comparing it to the past precedent of under-allocating there.
Treasurer, a lot of the pension funds that are underfunded have a hard time in private equity, just because they can get caught in a big downdraft. Some of these funds, if they're funded at, say, 70%, they have 70 cents of assets trying to generate dollars worth of, distribution. So they can get caught on pacing, so they tend to be conservative there. Now, the funds that make up this generally have higher funded ratios. But still, that's an aggressive move over the last 3 years, 4 points. The last point I make to you is that generally on our private equity, we want to go higher. We tend to move that number to where we think we can get there in the next 3 years, and then reevaluate it at the next past allocations to see if we can go higher. So this last move was 15, up to 15%. Then we got blasted with the big inflows that held us back here for the closer term.
I'm sure that's why I don't think it's surprisingly, because you have a very small group of 35 out of all of them, and to Vince's point, most of those are funded. Most pension funds are not funded. Most of them are between 60 and 70%. And they are very different than us in the sense that they have to pay the bills. And when you already have an unfunded pension fund, it's a lot more riskier to do the private equity. So they have moved a little bit in the direction from going to nothing, so that's why the 4% looks pretty shocking. But it's because they're trying to get there. A lot of them still have an interim target and have not reached the point of where they want to get that private equity. I think for me, one of the questions, because I've heard it already 3 times today, that we're looking at
putting endowments as part of the evaluation. I don't know enough about endowments to know the differences. I definitely know enough about pension funds to know that there are huge differences between us and the pension fund, and sometimes when you guys are putting apples in there, it's pineapples, it's not the same. So what is the differences with putting those types as an evaluator with our sovereign wealth?
So generally speaking, endowments, they have a lot more flexibility and they can be a lot more aggressive. It also comes back to that asset liability management exercise that we have to go through. We are sovereign wealth fund, but still we do have certain liabilities that we have to match. And with pension plans, they have a completely different set of liabilities, and they are doing that exercise on a lot higher scale than we do. Endowments and foundations also do have some liabilities, but mostly the money used from the proceeds are to cover operational expenses of those institutions. So they can be a little bit more flexible, I would say. And number two, as I mentioned before, the types of strategies that they can go into are generally a lot riskier than the ones that we are accustomed to seeing here.
Madam Treasurer, I'd add to that. One of the downsides to that, one of the negatives to looking at the endowments, particularly the large ones, are those funds compete hotly with each other. They put the pedal to the metal for another 10 basis points, so they can report in the Kubo report and other places that they outperform. It is intensely competitive and hotly competitive, and I think they're taking artificially high investment risk just for that last 10 basis points to beat people next to them. So it's a little bit dangerous to move into that area.
Madam Chair, I think that's my point. I'm glad that Vince is saying that, because that's where my concern would be. They also don't have a responsibility the same way that we do as public servants or as council members. Their statute responsibilities as a council is very different. Their risk environment and what they enjoy taking risk on is very different. I think for me, I still need to get a better understanding of, are we paying more than what we should be paying for the amount of risk that we're already taking? And I'm not in the game for us to take all of the risk that we have when we're doing an excellent job where we're at right now. Can we always improve? Absolutely, we can. But I'm not trying to take the second largest sovereign wealth fund into like basically a gambling sensation. And it's not just the risk on dollar amount or the pay on the fees. There's also the risk of liability when they sometimes invest in things that don't align with values of the Mexicans. And so I would just say, before you bring that before the council, please know I'm not on board, and I need a lot more information before we have that discussion to be a little bit more thoughtful. Because I've heard it 3 times today, so hear me 3 times times 3 now.
Yeah, we would expect it to be additive and have to do some work on that. It's really a matter of how do we expand the universe? How do we bring broader perspective in that maybe captures the other side of that? Because when you look at this vision frontier, it looks like New Mexico is way out there, and it's true in this grouping. But I think the additional context that it could add is all the caveats that you rightly added, because their private market exposures can be 60, 70, 80%. That's not reflective of SIC. Sort of a bookend, and you're somewhere in the middle. But you're right, we need to do some testing to see, is this actually helping the discussion, or is it detracting?
Are you all?
Yes.
Is there further questions? Folks online? All right, hearing none, thank you, and we're gonna head into our PMRs. We've got 5 of those. So the first is real estate, with Director Stable and Townsend.
morning, Madam Chair. My normal sidekick, Rob Coaches, is going to be joining us by Zoom. He spent about 4 hours of his holiday yesterday on a runway in Cleveland, and when it became clear that he wasn't going to make it out here to Denver in time to make his connection, he figured Zooming from Cleveland was better than Zooming from Denver. Couple of real brief comments in terms of introduction. On the real assets structure study, or not structure study, PMR rather, we lagged in performance for Q4. That's contrasted with the performance over 1 to 10-year measurement horizons that are also in the report, where the real estate book has outperformed. In terms of market fundamentals, they still remain intact. Supply growth is restrained. NOI growth is still expected to be relatively strong in a couple of our key sectors, industrial and residential. With that, I'll hand over to Rob for his comments.
Thank you, Keith. Can everybody hear me okay?
Yes, sir.
Okay, great. Our materials start on page 90 in your book. I'm going to actually start on page 93. And I'll try to be brief and obviously open to any questions you may have as we cover the highlights of our report. We are covering your real estate performance as of December 31. Private markets, you know, are usually about 90 days lagged in terms of reporting. So we're at year end 2024. And we have a little bit of data in on the first quarter and no major changes between the first quarter and the fourth quarter, but our report is complete through year end 2024. So on page 93, as Keith said, the portfolio underperformed slightly in the fourth quarter, but over the long run, you continue to perform better than your benchmark. But over the last 5 years, the returns have been relatively modest. You've been modestly positive over the last 5 years, modestly negative over the last 3 years as the market's corrected. And if you look at the chart on the lower right-hand side of page 93, we track real estate market values quarterly. And if you look at the right-hand side of that chart, you can pretty clearly see where COVID kicked in. And then we had a period of really substantial market volatility associated with a lot of stimulus coming out of COVID, and then a lot of correction associated with higher interest rates generated by the Fed. So it's been a tough 5 years for real estate, and through that period, your portfolio's returned just under 4% net over that 5-year period going back to 2020. So positive results relative to your benchmark, good results, but just modest for real estate history. The one thing that we would note with respect to the fourth quarter of 2024, we have most of what we see in your numbers that is driving that negative result is related to currency fluctuations, believe it or not. You have almost 18% of your real estate invested overseas, and there was a pretty strong strengthening of the dollar in the fourth quarter of 2024. And as we look at the numbers across your portfolio, we can attribute almost all of the negative returns that pop up in your portfolio that quarter to currency fluctuations as we translate your foreign currency investments back to the US dollar. I'll say that in the first quarter, that pretty much reversed, and the dollar's been weakening since the beginning of the year, 2025. So that might be a little bit of a boost going forward for your numbers. If you turn to page 94 and really thinking about the next 2 pages together, your portfolio right now is roughly split 50-50 between core income-oriented real estate strategies and more growth-oriented non-core real estate strategies that include the value add and the opportunistic. And over the last couple of years, that actually has adjusted quite a bit. So the portfolio's been moving towards more growth-oriented strategies as the cash flows have been coming into your program, and the priorities have been more growth in the future versus paying out current income to your beneficiaries. And we expect that to continue. So on page 94, we look at the core portfolio performance, and that's about the same as the overall portfolio in terms of above benchmark, slightly below benchmark in the the fourth quarter of 2024. And then if you turn to page 95, the non-core, more growth-oriented strategies, we use a little bit of a different return metric. There we're focused more on IRR and equity multiple versus time-weighted returns. So on page 95, looking at your non-core investments, what we do is we group those by vintage year, and then we track your performance each vintage year for the investments that you made during that year versus a peer universe. And the takeaway on page 95 is, again, for the last 10 periods, really you only have 9 there because one year you didn't make investments. But over the last, 7 out of 9 years during which you made non-core investments, your investments during that period have outperformed their peer universe, which is good. So solid performance over the long run. Going forward, you're going to see a lot more of the non-core investments. And you made about $3.3 billion worth of non-core commitments over the last 5 years since 2022. Let's call it the last 3 years, sorry, since 2022. And so you'll see a lot more of this non-core investing going forward and the impact of that on your portfolio. Turning to page 96, thinking about your funded status, the target exposure to real estate is around 11.3%, roughly, if you combine all the different funds and the various real estate allocations on a weighted average basis. That's about $6.5 billion of targeted real estate exposure. Currently, we are at $4.1 billion, so materially under your target. But again, you've made over $3 billion of commitments in the last several years. And if you look at the chart on the bottom, the bottom right-hand corner of that chart, your current market value plus what you've committed but remains unfunded totals about 111% of your target in real estate. So you've got the commitments out there, and there's sufficient commitments to build the portfolio to your target, but the challenge has been slow capital calls from the managers as the market corrected and transaction volume declined. And if you turn to page 96, again, stating the same thing again, the chart on the left shows the level of new commitments that has grown significantly in the last 3 years. The chart on the right on page 97 shows the level of commitments, the green line, which is increasing steadily, and then the black line is the amount of capital calls from your managers. And what you see is a spread between the two as you've been making commitments, but they're not being called by the managers because the market's just been slow and it's not been a good environment to invest. But the commitments are there to boost the portfolio, and as the market stabilizes, we expect a lot more capital calls. In fact, you've actually seen the level of capital calls increasing. It was over 600 million in 2024. Compare that to about 300 million in 2022. So the level of capital calls, has been increasing significantly over the last couple of years. But you're still playing catch up. On page 98, just a quick look at diversification. Your portfolio is very well diversified by every metric. Here we look at property type and geography. We've talked about many times in the past, you're well diversified by sector, and the overweight to the industrial sector in particular has been helpful to your performance. That's actually the only sector that generated positive appreciation over the last 3 years. When I say only sector, I mean the only major sector between the 4 major sectors: apartment, office, industrial, and retail. So that's been very helpful. The other category, a lot of specialty niche property types, is where we've spent a lot of time, if you recall, from recent commitments that were made and managers that come in to present to you. So we're looking more at the niche sectors and bringing more of those opportunities to you, because that's where we see some better growth metrics going forward. So you'll see continued overweight to industrial going forward, and then continued growth in more of these niche sectors as you go forward, because they have better growth dynamics projected. Geographically, again, the portfolio is very well diversified across the country, and one thing that sets you a little bit of apart from a lot of your pension fund peers, for example, is the higher international exposure, which we talked about earlier, and that does add some volatility to the portfolio with respect to currency. Again, you're roughly 17.5% invested in overseas markets with your real estate program. The next couple of pages, we talk about some manager-specific or fund-specific issues. I'm going to skip those in the interest of time. Happy to answer any questions there, and move to the final page that we like to present to you, which is compliance with your investment policy guidelines. And we have a number of risk guidelines in place to manage risk in the portfolio, and you are in compliance with all of those guidelines as shown on page 101 in your material. The one issue that we have right now is the actual exposure to real estate 7.3% is below your target range, which is from 8 to 16%. So again, the actual exposure is lower than where we'd like it to be, and you're in a catch-up mode, and we anticipate that that'll improve as the markets stabilize and the managers call more capital. The rest of our report is some appendix materials, a market review, and all of our detail about your portfolio, which begins, I think, at page 108 in your materials there. With that, I'll stop and I'd be happy to answer any questions.
Does the council have any questions at this point? I just have one question on page 11, the caution and green light significant events. Is there anything on there that you wanted to address to the council for them to be aware of?
Yeah, so we do kind of look at things occurring in the portfolio. A couple of things that have been in this report for quite some time. The Jamestown Fund, for example, we've talked about quite a bit, and that fund has struggled. It's actually turned around a little bit. They've culled the portfolio, sold some non-strategic assets, and the portfolio composition has improved, and the performance has been improving there. So we're still monitoring that. The Ares transaction, Ares has acquired a number of different platforms as they build their investment machine, if you will. And so there was another acquisition of GLP Capital Partners, which is an overseas logistics, industrial related manager. And we don't expect to take advantage of that through the Ares platform. We don't see much more investment in that particular fund and fund series. But in any event, it's just something to monitor as they grow their platform. The other two investments, UBS Trumbull Property Fund and Claren Line Industrial Trust, you have a number of changes in terms of personnel, but nothing that we think is worth the red category, if you will, in terms of a real concern. It's just something that we're monitoring.
Thank you. Anyone else? We'll move on. Whenever you're ready, sir.
Great, thank you. So, Madam Chair, I think everyone now is aware that Amy is going to be leaving this relationship. I want to take a moment to add expression of my most sincere gratitude for her work with me on this portfolio. I've been an investor for longer than I care to admit at this point, and finding somebody of this caliber is just really unusual. There's been tremendous philosophical alignment Amy brings deep analytical rigor to everything that she does, and deep thoughtfulness as well. She's an exceptional talent, and an extraordinary human, and she's going to be missed by the staff. Joining us today is Amy's replacement, Gurjit Dosanjh. He's a Berkeley-educated investment banker from earlier in his career. He worked with HSBC in London. He spent 15 years with Mercer since then, working closely with Amy over that time frame. He and I and Amy have spent several hours working together in our normal joint work sessions. Gurjit has also participated in several joint manager diligence calls with me at this point, and so we've worked together for something on the order of 10 to 15 hours at this point. And I found those conversations to be quite rewarding. He's going to be a great addition to the team. He does have big shoes to fill, but I'm very confident in his ability to deliver the goods. With that, I'll hand over to Amy for the maybe the introduction of Gurjit, and then into the queue.
Well, thank you. That was like very touching. I'm even getting choked up. I've really enjoyed working with everyone here over the years. It was funny, actually, my first ever council meeting was on I remember flying Memorial Day and being here, so it's very apropos that this is now my final. Like I mentioned, I'm taking a little time off to be with my family and then figure out my next steps in life. I've been here 17 years now, a very long time, pretty much my entire career. So thank you for being a part of it. New Mexico SIC has been such a long-time partner to us, and thank you to Keith and Chris and Bruce. And I'm leaving you in very good hands, Gurjit, and I have worked together for 15 years. We've been through the acquisitions. His wife had a child at the same time that I did, so we've even been through life events together. He is an amazing human being, as well as very, very well versed in real assets and private equity. So I will leave it to you but I fully endorse, and I think that he will be a great match for you all.
Yes, thank you, Amy, and big shoes to fill indeed. I've joked with Amy, I don't think anyone's sadder, because I've actually sat in the Sacramento office with Amy for 15 years. We've worked side by side, marriages, babies, we've done it all with our respective families. But no, really look forward to working with the council, and very excited about what's coming down the pike.
So moving on to the performance update. So on page 138 of your materials is where I'm going to start. It's labeled performance overview. So essentially Q4 was actually a pretty flat quarter for you all, a 0.1% difference. So, but you do see overall we maintain positive performance in each of the time periods that you see here. I would reiterate throughout this, you should expect to see the changes from the structure study that Keith was mentioning in the next iteration. So this should be our last iteration in these categories. And then I would also just mention, so about $1.5 billion in gains since inception from the real assets portfolio. And you see the third bullet down, it was a very busy 2024. We had 5 commitments totaling $920 million. We also did $402 million of top-ups. So a very busy year in 2024, and that will tie into some of the cash flows that you see later on. The next page, we look the performance by strategy on a year-over-year basis. The total returns have gone up. You went from 1.28 times to 1.31 times multiple, and a 6.4% IRR to a 6.7% IRR. Your MLP was the largest increaser during the quarter. And then the next page shows the NAV bridge, and this really shows you like where is the value coming from, because there's a lot of different things that go into building value here. So this shows the last 2 quarters. There was, you see last quarter, it was really the increase was from the net gain in the portfolio. And this time you see a very large contribution amount, and that again ties to what we just talked about, the increased pacing that we have had, all those commitments that you all approved in 2024, and so you really see that coming through in the contributions. You did have some distributions and, again, a pretty muted gain. So that was really what was driving the increase this quarter. And then on the next page, we look at contributions and distributions, and then gains and losses. So overall, contributions outpace distributions. And you will see from the top right corner, that's the contributions. All of those were the 2024 vintage years, so directly tied to that increase in pacing. The distributions, I did want to point out, there's a lot of headlines about lack of distributions across private markets today. We are still seeing them. They are slower, but you actually did have your top distribution was a full sale of and full liquidation of an asset, so that was good to see. And your second largest distribution was from a refinancing of a property. And so you are still seeing some distributions and full sales, but it has definitely slowed. And then on the gains and losses, your MLP was really what was driving the gains for the quarter. And then your losses, you had two that were driving that. Those are just in the J-curve, that brand new investments that we just made where they're still have expenses and they're in the J-curve, so nothing to be concerned about in that net losses. The next page is the PME. So this is one change that we were able to make from the structure study when you all approved the change from CPI plus 3 to CPI plus 4. So you do see that change here. We are slightly under, as we talked about in length during the structure study. That's expected to continue as we ramp up and we have more funds coming out of the J-curve. And then the next two pages will be my last pages here, are really showing you the different diversifications. You have a well-diversified portfolio. On page 143, you see, and again, these categories will be changed to match the structure study, but we are in line with where we want the targets to be when it comes to infrastructure versus natural resources. So we are in line with the stated targets. And the next page shows diversification by geography and industry. And this is actually at the underlying asset level. So this is really giving you an understanding of where the underlying assets and investments within the real assets portfolio are. You see, we do have the North America is the largest, but we did make a lot of new European fund investments last year, so we would expect to see that European exposure move up. And then you see you're well diversified from an industry direction as well. Again, those industries will be updated next quarter. And in the appendix, you have your top GP exposures and your quartile rankings for each fund within there. I wasn't going to spend time on those, but those are in the appendices for you. So Keith and I are happy to take any questions.
Madam Chair, I don't have any questions, but I do want to thank you for your service and for serving New Mexico with integrity and being one of the first consultants that I met when I was treasurer and talking to you a lot more about the importance of diversity, equity, and inclusion, and then finding out you got honored by the Power 100 last year, and this year, and so I just want to thank you for everything, and I wish you and your family the very best.
Anyone online?
Madam
we
Chair,
hope that you go, okay?
Sorry, Madam Chair. Wanted to echo the treasurer's comments, just having worked with Amy on the investment committee, our consultants are really a key part of our team and growing value for our beneficiaries. Want to thank her for all her work on their behalf.
Thank you.
Echoed. Thank you, Amy.
Thank you.
Now we're on to agenda item 2H.
Hi, thank you to the council members. I am participating via Zoom today. I appreciate that. And Tom is unable to attend the meeting. So I'm going to keep my presentation fairly short, consistent with the other asset classes. We're presenting performance for as of Q4 of last year. So as a reminder, as we've discussed multiple times, we're restructuring this program. So a lot of this is reflective of performance pre-restructuring. And so one of the things that we're in the process of doing as well is restructuring this report to give the trustees and the board, committee members more visibility into that, into kind of the ramp of the new program and kind of the go forward. So I'm going to skip a number of pages and hopefully provide more clarity in terms of that distinction. So in terms of your program, we do have a long-term target of 15% to private credit. Again, we're in the process of ramping that up. We've had a busy year last year, and we'll talk through that in some detail. But in terms of the overall program, you have $9.8 billion committed across 62 investments, representing a market value of roughly $4.5 billion. Across the total program, the IRR is a net 6.3%. If you strip out what we have referred to and have walked through previously, what we call the legacy, as well as the liquidating component of the program, which largely ties to the legacy hedge fund program, that is $7.7 billion of commitments across 49 investments, representing $4.5 billion of market value, with a net IRR of roughly 9.9%. So I failed to mention I'm starting on page 153 of the board book. So on the next page of our performance report, we highlight for you the breakout in terms of the strategy allocations. As we mentioned at the last meeting, we're starting to break out the real estate debt component and highlighting that that now represents roughly 10% of your program. What we're in the process of doing is working with Tom to restructure the strategic allocations. Obviously, it's the pie is 100, so we need to reflect that in terms of the target and the model portfolio, the targeted allocations rather on a go-forward basis, and we'll circle back on that. We'll circle back on that next time as we're working through that. But the main point as it relates to this page, as you can highlight, the thing that really we would draw your attention to is the 9% allocation in what is called the asset-based component, consistent with what we've highlighted and consistent with the commitments that we've brought to the council recently. We're really looking to increase that allocation to your program, and we'll when we walk through the performance by strategy allocations, you'll see that that's actually one of the best performing segments of the program, and that's consistent with kind of our overall philosophy in terms of the orientation of this program to more yield-focused strategies, more income-focused strategies, where you're able to recycle and compound the return. So again, what we're trying to do in terms of the restructuring of this program is focus on yield-oriented opportunities and benefit from your positive cash flows and move away from opportunities that are more focused on capital appreciation and in turn have more variability in terms of performance. So again, expect over time for that diversifying component of the portfolio to decrease materially as you do see an increase in the more income-oriented components, most notably the asset-based strategy allocation. That's illustrated graphically on the next page. That significant restructuring is what's illustrated on the graph on the left side, as well as the graph on the right side. So now what I draw your attention to more notably is on page 156 of the board materials. And here what we're showing for you, and I think this is more meaningful, is the breakout of the performance by strategy type. So as mentioned, the asset-based strategy, which represents 775 million of commitments, roughly 405 million of market value, has a net IRR of 11.3%, which is consistent with what we expect in terms of the long-term performance of this portfolio. You can see that from a performance standpoint, the legacy and the liquidating, the legacy having an IRR of 4.2% and the liquidating since inception IRR of 3.4%. Those are, some of the things that are pulling down the performance over the long term. Those do represent a significant percentage of the historical commitments, but many of those have been liquidated, and so they're representing a smaller and smaller percentage of the market value of the portfolio. But we do need the program to ramp in terms of the new commitments, and as those continue to be invested, the performance should obviously improve, and we should see that gap between the total and the ex-liquidating and liquidating compress, and hopefully over time it won't be necessary to show the two split out. I'm going to skip over the next few pages of the performance report and draw your attention to page 158. This is just a quick reminder to the trustees that in 2024, you did make 11 commitments representing $1.9 billion in private credit. Year to date, you have made 4 commitments representing $700 million, and we are on target to effectively match the commitment level of last year. With that, I'm going to jump forward to, I think, what's probably one of the most meaningful, pages in this report, which is 165 of your report, which shows you the horizon IRRs over time. So you can see on a 1, 3, 5, 10, and since inception basis, the performance for the various sectors or the sub-strategies, as well as what I've been trying to highlight, kind of that performance differential between the historical, going back to 2012, which is when you made your first commitment in this space, to 2022, and then kind of that post-2023 performance. I would highlight that over short periods of time, such as a 1-year period, an IRR is not typically a statistic that we do show. We have no expectation of having a north of 20% IRR. We're not trying to represent that at all, but you can see that there is a meaningful difference between the performance historically and the performance more recently, and we do want to just draw that to the attention of the trustees. We're planning next quarter to bring this table, this page forward in the presentation, because we do think it's so helpful to highlight. So over the 1-year program, or over the 1-year period, your total program returned 10%. That did modestly trail the PME equivalent over the 10-year component, but as highlighted before, the asset-based segment of the portfolio was the strongest performing component of your program. It was really the legacy and that liquidating part of your program which dragged down performance for that period of time. Again, that's becoming a smaller and smaller percentage of your program, and so hopefully that should have less and less of an impact on a go-forward basis. But happy to take questions, but I think consistent with what we've, articulated to date, our focus is on bringing more yield-oriented strategies with strong downside protection to the council to review.
Thank you, Mary. And questions from council? All right, hearing none, we will move to agenda items I and J, our private equity program.
Go ahead and pass it straight to Richard.
Thank you, Madam Chair. Good morning, Council. We're going to cover the National Private Equity Program first. And we're starting on page 185 of the materials with the slide titled Performance Overview. And I'm going to hit on some key themes and then happy to answer any more detailed questions that you might have. I mean, some of the key themes to be aware of with private equity, the long-term performance has been strong. You can see this here in this chart, the 10-year, the since inception return, particularly for the 2011 and after portfolio, 14.6%, 14.7%. That compares favorably against private equity benchmarks as well. Shorter term, private equity hasn't performed as you would expect it would perform. You can see the 3-year at a 2.6%, for example. That's consistent with broad private equity industry. It's just underperforming the last few years, particularly against the public markets. And I'll go into more details on the public market performance on a later slide as well. We also have a portfolio where we've been ramping up commitments since 2023, and so a lot of those new commitments as they draw capital are actually going to be a drag on overall performance just because it takes time for private equity funds to generate value. For the quarter, though, it was only, there was just a small loss in the quarter of 0.3%, which equates to about a $13 million loss. The 1-year return is at 4.9%, which is actually slightly above the 1-year global private equity benchmark. And the overall since inception didn't really change much at 12%, with an over $4.4 billion gain from private equity since inception. The next page shows the summary dashboard of the different strategies. You can see that growth and buyout continue to be the strong drivers of this portfolio. They're also two of the largest allocations in the portfolio. They were two of the larger allocations that we talked about when we did the structure study for the National Private Equity Program. The net asset value actually didn't change that much. It just increased by approximately $6 million when you think of all the activity that was happening underneath the surface there, which on the next page you can get an idea of what was happening there with the $6 million increase. We had $161.5 million of contributions in the quarter and $142.7 million of distributions. And the distribution number has been pretty strong for what we're getting from this portfolio. I mean, you've heard in the industry that private equity distributions in particular, that's one of the top concerns with private equity investors. They want more liquidity from their portfolio. And we've actually been getting good distributions to offset some of these larger contributions that are coming from the newer commitments. And just for the year 2024, we were at a net contribution of about $373.9 million, but we received almost $500 million of distributions in 2024. And so far in 2025 through mid-May, we're at a net contribution position of $142.9 million, and we received about $160 million of distributions through mid-May. You can see the gain there, the loss there down $13.2 million. One of the drivers of the losses was kind of interesting this quarter, and I heard it mentioned in the real estate, was the currency. I mean, we have some funds that are based in Europe, denominated in euros. We have some Asia exposure as well. It seems like a long time ago now, but in Q4, the dollar was strong, and that actually caused some markdowns in the European-based, the euro-based funds that we have in the portfolio. But that's going to be reversed in Q1, so you're going to see a lot of those possibly on the largest gains for the Q1 portfolio as the U.S. dollar is weakened. Turning to the benchmarking, I mentioned one of the themes is the benchmarking against the global private equity benchmark. You can see here that, almost all of the vintage years were above median by vintage year. With some in the top quartile, there's There's one, 2013, where the multiple is just slightly below the median cutoff. It's 1.51 versus 1.50, so, I mean, it's right there. And the next page shows the public market equivalent performance against the public equities. And this is really another theme. A lot of investors will use Russell 3000 as their benchmark, and the Russell 3000 has really been dominated by large cap tech stocks. And so private equity overall has been underperforming the Russell 3000, which has, you know, a lot of large cap tech, which private equity doesn't have that same type of exposure to large cap tech. But when you have broader benchmarks like the MSCI ACWI, which is a global benchmark that covers developed markets, or you take the 2,000 smallest companies out of the Russell 3000, which is the Russell 2000, you can see that the private equity portfolio is still outperforming almost by 4% on the Russell 2000 and just about 2.7% on the MSCI ACWI. Diversification by strategy, I hit on this. Buyout and growth are two of the largest exposures that we have. They're also two of the best performing. We're selectively growing the venture capital, have a high bar on the managers that we're bringing to you. We want to bring the best managers in venture capital for the national program. And then the diversification by geography and industries. These do look through the portfolio what the actual company exposures are. The geography is at 72% North America, 17% Europe, and then 11% Asia and emerging markets. And then from an industry standpoint, most of our exposure is to information technologies, but the second largest is industrials and materials, which has also been an area of good return for private equity. I'll conclude my remarks there and happy to answer any questions about the national program.
Question. Yes, question. So you just stated you're looking for the best managers in venture. So what makes them the best? What's part of your analysis?
Yeah, so we look at a lot of different factors in trying to find the best. So one is experience. You know, we're seeing an economic cycle right now, and that's impacting a lot of venture capital investors that might not have that deep experience. So you want people that have experienced these types of markets because they know how to work with the portfolio companies to conserve cash and be able to understand what needs to be done to kind of wait for that next funding round, because it might not be as easy as it was in 2019 and 2018. We also look for on the strategy side those that have strong conviction on where the market's going to go, because on venture capital in particular, it's much more early stage on the technology. So you want to see where the technology is going. A lot of them were investing in artificial intelligence more than 10 years ago. You know, so what's going to be the next thing beyond artificial intelligence now that that's the hot topic right now? And then finally is track record. I mean, we've got to look at performance. There's got to be performance. The hard part about venture and track record right now is realization and the lack of realization. So a lot of the valuations might be stale, might be 2 or 3 years old. So sometimes you really have to dig into the portfolio to understand how those companies are performing and understand what that track record is.
I would say lastly, it's the only asset class probably that we invest in. I think buyout has a little bit of persistence. Venture has a lot of persistence. And the reason there's a lot of persistence is founders can choose who to raise money from. And they want to work with groups that can add value to their company, but have great track records who they want. They're associating themselves with. If they can raise money from, pick a name that's famous, like a Sequoia, you know, Sequoia's going to have an advantage over most other VCs. Such a brand name in VC and comes with such credibility. One of the big things about venture capital is the down payment on, you know, an unknown future for the founder. They have a bet on where the future is going. That's why they started the company. And the better venture firm they can raise money from at the early stages is almost like a vote of confidence. Maybe that can occur in the future. Makes it easier to get customers. It makes it easier to get acquire talent. It's a really important part of this asset class. It makes it kind of unique relative to, let's say, public equities, where any of us could go right now and log into our brokerage account and buy Microsoft stock. No one, you know, that doesn't exist in the venture world. There's only so many people that get access to.
And then, Chair, based on that answer, there's a lot of venture that's brand new. They might have come from somewhere else. They started their company, and they're very brand new. So when you look at experience, strong conviction, track record,
how do you allow the doors to be open for those that are new, but they're thirsty?
Yep.
They have experience, but not necessarily with that venture fund. And they might be newer, younger overall, but have a lot of that experience. How do you find that process to work for you?
Yeah, it's a good question, and you know, we have brought Fund 1 and Fund 2s for the portfolio, particularly the New Mexico program. You know, part of it is just being in the industry a long time and getting to know these different firms and seeing the type of deals that they do at other firms and then spinning out and starting their own firm and talking to other people that are out in the industry who will give you insights into who are really the strong investors and who should you back. And that's how we get comfort around some of the Fund 1 and Fund 2s is, you know, having some type of track record or some type of history that we can look at with them.
Got a question from the section as well.
Madam Chair, just curious about, our investments that are going out, trickling down to real companies. Are we seeing any effect of, the uncertainty because of the tariffs?
Yeah.
What's the response to that?
Yeah, I think that the companies are experiencing the same uncertainty a lot of the large public companies are doing. I mean, you know, with the private equity companies, a lot of them are smaller, so they might not necessarily be directly impacted by what's going on internationally, although a lot of them want to grow by selling into international markets, and that's one of the benefits that private equity brings to a lot of these firms is helping introduce them into international markets. You know, the big concern right now is kind of the secondary order impact that could potentially come. You know, with the weaker economy, if the consumer stops spending, if businesses start putting a hold on spending IT budgets, you know, a lot of our portfolio is information technology and software. That's where it could potentially impact those companies.
I'm sure I did not mean to cut you off. Are you finished? It's okay. You're good. Okay, members, no.
Madam Chair, do we have a schedule of the maturities of these investments?
We don't. I mean,
And should we have one based upon the outflow chart we saw earlier? That we're anticipating to spend more money or to give more money back to the state, and what these maturities look like for these investments?
well, a lot of these funds, I mean, they do have kind of a life of 10 years initially, but then they can be extended by the general partner, and usually limited partners review it as well. In the New Mexico program, some of the legacy investments are 20 years plus now, even though they started out initially 10 years. And so it's really hard to kind of pinpoint what the exact realization date is going to be of the fund. But I mean, we have what the date is now, but you know, especially with hold periods lengthening, it tends to be much more uncertain.
That's why we track it by vintage year at the end of the day, because, but, you know, just to give you a sense of like how big of a sea change has occurred the last 3 years, historically, the distribution rate of the private equity industry has been 20 to 25%. And what I mean by that is distributions divided by beginning NAV. Now it's like 10%. And so not only are distributions slowed, but pacing slowed a bit too. Depends on the manager. It got particularly fast in the 2021 timeframe. So I would say one thing we're thinking about a lot about on the pacing side is what is a normalized environment? Because the 20-25% a year environment may have just been the last decade, low interest rates and a lot of liquidity. Now it's definitely slowed down. You know, the individual experience of managers is different in the portfolio, but I would say overall things, anytime you have this much uncertainty, we went from higher interest rates, higher cost of capital, Ukraine, Russia, now tariffs, probably missing some other disaster that occurred recently. Lots of stuff has changed, but this uncertainty slows the system down. And one thing you may or may not have noticed is some of the investments we've made recently lean towards the special sit side where they don't need the debt markets to be fully open to do deals. They can buy businesses that are maybe dealing with a little bit of stress right now. The reality is that there's a lot of small businesses or medium-sized businesses that are dealing with stress right now in an environment that's changing this quickly and this dynamic.
And then the treasurer had one more question.
You reminded me, on the other goal, I think what I've heard from you guys, particularly in the New Mexico stuff, but in both, is those studios are very helpful. And I think that's another avenue, is when you have some type of resource that aligns, some type of support, it doesn't have to be the studio that shows that they're not in it alone, that they can help get support on that end is very helpful too. My only question is, I know there's a logical reason, but I need a reminder as to why first, quartile, second, third, fourth, by the vintage year, you have it in the report several times. Can you remind me why we do that?
Yeah, I mean, it's really comparing against the benchmark of different funds that are out in the private equity universe.
Within that quartile.
And we want to measure, our goal is to be above median. And so we want to measure where is our portfolio tracking compared to those different quartiles. And it's hard to get top quartiles just because that means you're probably taking a lot of risk to try to get the top quartile, but we want to create a diversified portfolio in each vintage year where we're getting at least above median.
I would just ask if you could make it a little bit bigger and put some different colors that actually, red and green for me mean different things than first, second, third quartile.
Yeah.
So every time I see red on your guys' report, I'm thinking I got to look at something that's urgent instead of it being that it's identifying a quartile, and then just a little bit bigger because I'm getting older.
Okay.
I'm cross left. Thank you, Madam Chair.
Anyone online? And just so you all know, I can't see you, so if you just shout right out and interrupt, we'll get to you. I apologize if we've been neglecting the folks online. Anyone from the council online for questions on this item? All right, hearing none, we'll move to the New Mexico program and round out this portion.
Thanks, Madam Chair. And I know we spent last month, a lot of time talking about the New Mexico program as we went through the structure study. So I'll just hit on the quarterly performance, since we did talk a lot about the makeup of the portfolio, the composition, the plan going forward. The New Mexico program's performance was flat this quarter, although the same themes that we talked about last month still apply. We basically still have a large allocation to the co-investment funds. It's about 25% of net asset value. These funds are less diversified, so the movement of any one company in those do have kind of a magnified effect, positively or negatively on the portfolio. When we look at the longer-term returns, there has been positive performance from every type of investment except the co-investment funds and then the older fund commitments as well. But overall, there is a loss in the program of about $84.1 million. And I like to talk about the progress that we made. At the end of 2018, the one manager was 75% of net asset value. When you add in the new commitments that we've made, they're down to 17.5%. We really diversified that. And we have 3 companies accounting for 76% of the value. And those 3 companies are now down to 21%. And so hopefully continue to diversify the portfolio with the new commitments will help manage the risk of this portfolio. One bright spot is the newer fund commitments right now, the 2016 and after. You can see there's a gain of $39.5 million, or a since inception return of 6.6%. A lot of these are still in their investment phase and still trying to find new investments, work with the investments to generate value. And so that's something that we hope will increase in the future, and we won't end up at 6.6%. But relative to the other categories in the New Mexico program, it's positive. And then skipping ahead 2 slides to the quarter-over-quarter performance, the net asset value did have a significant increase, and part of that was the contributions exceeding the distributions. We're getting a lot more contributions now in the New Mexico program from the new commitments that we've been making. But from a net gain and loss perspective, I mean, it was basically even for the quarter. And then skipping ahead 2 slides, just the economic impact update. We have the number of New Mexico-based companies receiving investments are 128, with new companies funded over the last 12 months being 9 in the New Mexico program. And basically, the funds have invested $561.8 million in these companies, with about $19.5 million invested over the last year. And if you'll recall from the structure study, we're going to work on actually expanding this economic impact, because these are New Mexico headquartered companies, but we're going to also include those New Mexico operations. So the company might not be headquartered in New Mexico, but they're building a significant operation in the state. And so we want to be able to capture those numbers in the economic impact of this program. I'll conclude my remarks there and
happy to answer any questions.
Can you just remind me what companies who receive New Mexico incentives means? Is that like JTIP and those things, or, okay. Any questions for New Mexico? Yeah.
Didn't we say we were gonna split out what was part of the New Mexico Fund, and we're gonna move forward so we can see real numbers on the vintage of what we've done versus, okay. I just wanna make sure.
That'll be the next report, yep.
Okay, and then the 12 funds reported net gains, while 24 funds reported net losses. That's rough.
Yeah.
Any comment on that as far as, is that mostly the vintage, or is that stuff we've worked on recently, or?
Some of the newer commitments that are 2 or 3 years old have started to see some gains, but usually there's a J curve, and it could be a deep J curve with venture capital because the fees are higher. So, a lot of these new commitments, when they do their first capital call, will actually show a loss in the portfolio. So part of that is the new commitments, and then the legacy funds as well.
All right, thank you, gentlemen. We'll now move to agenda item 3, and I'll turn it over to our investment committee chair, Member Bingaman.
Madam Chair, thank you very much. We did have a meeting of the investment committee last week with a quorum. Member Tejas, advisor member Roman joined me in that meeting, and the committee unanimously agreed to recommend each of the investment voting items that the council is reviewing today. And that's my report.
Thank you, sir. Before we get to our actual investment votes, though, we do have a vote on the severance tax permanent fund asset allocation with Glacius on agenda item 3.
Thank you again, Madam Chair, council members. We are on page 231 of your diligence book. I'll give a brief introduction and then also turn it over to Matthias for some additional comments on the modeling. So this asset allocation update is largely a response to the the structure study change that you all approved for the Strategic Venture Capital Program, or the revamping of the New Mexico program, and how that affects our modeling for the severance tax permanent fund overall. So historically, the 9% allocation to the New Mexico program, in addition to the 3% ETIs, and when I say ETIs, separate from just the New Mexico program, I'm speaking specifically about the 2% required allocation to the Small Business Investment Corporation, or SBIC, that we have to make by law. In addition to the Small Business Recovery Loan Program, not the same as the $100 million to recovery loans that's part of the New Mexico program that was just part of the report you heard, but separately, the legislature in 2020 passed its own New Mexico Small Business Recovery Loan Program, in which it required up to $500 million of the severance tax permanent fund to be invested in very low returning loans to businesses who were struggling from COVID impacts. The actual amount of that got deployed was around $180 million or so, and no additional loans can be made from that program, but those lenders were given a grace period to begin paying back on those loans, and then roughly a 10-year period to begin that payback. So that roughly comes to another 1%. So that 3% ETI allocation does need to be accounted for specifically in the severance tax permanent fund asset allocation, because that 3% cannot be allocated to other assets. And we do want to also make sure that we are fully accounting for the full 9% allocation to the Strategic Venture Capital Program, which you all just reaffirmed last month in your vote, that would continue to be 9% specifically to that program. And since that program is switching to more market rate investments, we want to be sure that we are being fair to that program in the modeling to show the potential impact for additional return from those investments. So what you see here in front of you on page 231 is how we will specifically be accounting for the ETIs separate from the Strategic Venture Capital Program, where the 3% allocation for ETIs is broken out, 9% for the for the Strategic Venture Capital Program, also separated, and to more or less account for that 3% ETI to separate it, be reducing the allocations 1 percentage point each for private credit, real returns, and real estate. I'll now turn it over to Matthias to discuss the modeling implications that has, and we'll also be happy to bring questions.
You have a question now? Yeah. Just for clarification, ETI is the economically targeted investment. Is that by statute or is that by policy?
That is by the statute, required by law. Unlike the Strategic Venture Capital or the former New Mexico program, which says the council may make investments up to a certain percentage, the SBIC and the New Mexico Small Business Loans are a shall. We have no choice but to make those as required by law.
And Madam Chair, that was the second question, is the Small Business Investment Corp done through Russ Cummins as the executive director is what you were referring to when you were mentioning the percentage of the small business loans. It's not through SIC. That money is allocated through the legislature to SBIC.
The 2% required allocation to SBIC is run through that program. The other amount, the small business recovery loans that was administered during COVID, that's run by NMFA.
And how does all of that tie into what you're recommending?
Essentially, that comes to roughly 3% of the severance tax permanent fund portfolio.
It's kind of like encumbered, we can't use it in the other allocations?
Yes.
So they took 1% from each of the other ones?
Yes. To formally account for it. It's always been there, but the New Mexico program this is for modeling purposes, to come up with the most efficient strategic asset allocation and the long-term expected return. For modeling purposes, the 9% New Mexico private equity program and 3% ETIs are sort of all rolled in together. So it's 9% to New Mexico private equity and ETIs, not a separate allocation. But the structure study you all just approved last month said we want that 9% to be allocated to this strategic venture capital. We still have to account formally for the 3% that can't go into anything else because by law we have to invest it in these ETIs. So we just want to make sure that the asset allocation is being very clear, that 3% does have to be separately allocated for. If we're going to say 9% for strategic venture capital, then that 3 needs to come from something, and so it's 1% from each of the other private asset classes.
Maybe we may explain more.
Sure. Yeah, thanks, Madam Chair, and Dawn, I think you explained it well. This is really, I would say, the last step in this process. You might recall a number of years ago, the in-state wasn't even broken out, so we took a final look at that and said, in-state looks different enough from the private or from the national private equity program to separate that, and then this is sort of the third step in this getting more and more granular process. There's no change in terms of the actual recommended allocation. This item before you is really, as Dawn mentioned, it's acknowledging and providing testament to what was already approved, which is that split of 9% to the SBCP and 3% to the ETI that came through at the most recent meeting. So we wanted to acknowledge that to not have friction between what your targets are and what's actually in the portfolio. When you look at that, and again, it was thoughtfully designed in terms of sourcing those 3% that we're acknowledging for ETI from the 3 other private market investments. You're not seeing a big impact in terms of the expected return. Those are the 3 folded lines in the middle of the page. The expected arithmetic return, that's the top line return, down about 20 basis points. Risk, basically flat, down about 10 basis points. And then you have the expected compound return that's also down 20 basis points. So not a big change in terms of expected return, but as Marcia mentioned, the ETI, a bigger allocation to that with the historical returns that have been largely negative, is going to take a little bit of wind out of the sails. So we just wanted to acknowledge that, make sure that folks were comfortable and aware that this is the portfolio structure that we would be modeling on a go-forward basis. Don't anticipate a big or meaningful impact to long-term return and risk expectations.
We're going to vote on it.
Yes, it is the formal asset allocation. We are asking for your vote. One additional thing I'll draw your attention to is in the appendix of this report on page 233, and Matthias might be able to speak to this a little better, but this is the change in the capital market assumptions. So there's the National Private Equity Program and its expected risk and return profile, and then the expected risk and return separately for the new revamped Strategic Venture Capital Program, and then the ETIs modeled out separately on their own. So these different modeling assumptions are what's affecting the expected return. One thing I will point out is going back to page 231 and looking at that chart, when you see the difference when it says prior approach versus proposed allocation, that's using these brand new assumptions. But the thing I'll point out is if you were to compare this to last year's exact look at the severance tax permanent funds asset allocation, when the entirety of the New Mexico private equity program had different lower risk return assumptions without accounting for the new change in the program, that expected compound long-term return was roughly 6.7%. So these new modeling assumptions do actually increase the overall expected return of the program compared to that approach. But this comparison here, it's a little different. It's a little challenging to show the impact of those changes on a single chart. But these assumptions bring up that expected return from what we were looking at last year, not modeling or modeling the New Mexico private equity program as a differential rate program. Now with it being modeled as a preferred rate program, what this prior approach and proposed approach charts are showing you is if you had no ETIs separated out versus having the ETIs separated out. And that's the difference between those two. But this is definitively a higher long-term expected return than if you were to look at this exact same report last year for the expectation for severance tax fund.
Okay, I have a question. Okay, so I think there's a big section missing on that, which is what our current target allocation is. So if I pull the page from RVK, page 3 or page 25, because I didn't know where we were at as far as the current target or the interim target. So when you're looking at private credit, you're going from a 12% to an 11%, and we're currently at 6%, is that right, with an interim target of 10?
We are, roughly, yes. So this is a change to the long-term allocation. The interim targets are still an attempt to get to those long-term allocations.
I just wanted to make sure if I'm gonna make a decision that it actually makes sense for the staff to be able to do it, or that we're not above the target. I didn't know if we were or we weren't. So then the next one, we're at 8%, so we're fine. And then the third one, we're at 7.64%, so we're fine. And then the 9%, we're at 5%, so we're fine on that one. And then you're adding in the 3%, which we were at 0%, but we actually have invested 2.7% on the economically targeted investment.
That's correct, and that's what we're trying to correct.
We already have yet.
It brings you closer to all those targets.
Yeah. Okay, and then the only other question I have, because it's not clear in my head, when you're saying economically targeted investments, what exactly are we talking about? Is that the SIC money?
And the small business loans that the legislature approved.
Oh, with MFA?
Yeah, it's just those two.
Okay.
And we do have the statutory references in here on page 233, if anyone was interested in seeing when we say ETI, the specific sections of statute we're referring to, and those statutes where it says the SIC shall invest in these programs.
Okay, and Madam Chair, I'm on SIC too, and the legislature tried to take some money from them, so I just wanted to make sure we're not doing anything.
We are not doing that. If anything, we are codifying it. Yeah.
Got it. Further questions? Anyone online have questions on this voting item? Hearing none, is there a motion?
Madam Chair, I'm happy to make that motion based on the recommendation of the Council Investment Committee, Advisor RVK, and SIC staff. I move that the State Investment Council approve the updated asset allocation for the Severance Tax Permanent Fund as discussed and memorialized at today's meeting.
Proper motion by Chair Bingaman, a second by the Treasurer. Any discussion on the
motion before the council? Hearing no discussion, we'll go to a roll call vote on this motion.
Commissioner Stephanie Garcia Richards.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst. Yes. Nick Kaya.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Rick Summer.
Yes.
None in the affirmative. Motion passed.
Okay, thank you, and thank you very much. Thank you. All right, we're gonna move now to our investment voting items. We've got 5 of those. No.
One more.
No, pass it over.
Thank you, Madam Chair. I'll try to be quick, given the size of the agenda today. So 2 years ago, almost on the dot in June 2023, we proposed a series of interim targets for 4 permanent funds that were approved and successfully implemented by us. That was the result of the record inflows that we were receiving at that juncture of time, and that created artificially some issues in moving further into the private asset classes. Also, on top of that, a year before, in 2022, we received a general direction from the council to be more risk-averse and conservative in terms of our portfolio construction. So that all resulted in 3 major changes to our asset allocation and portfolio construction. Number 1, we have implemented interim targets to allow adequate time to move to the long-term targets in a more streamlined and structural manner. Number 2, we carved out specific allocations to cash that were not there before, and that ranged in size anywhere from 5 to 10%. And number 3, we also increased allocations to core fixed income, and we also suspended the lower and the upper limits of those core fixed income allocations in order to reduce the risk and allow us more flexibility in our portfolio construction. As of today, and that can be seen on pages 239 and 240 of your due diligence materials, in the last column of all those 3 tables that are in that memo, our actual positions are at or close to long-term lower limits. Proposed interim changes further breach this gap and allow us to move closer to the long-term targets set for those 4 permanent funds. The 2 major outcomes that we see coming out of that proposed shift are the following. So number 1, as you can see, we are bringing U.S. and international public equity allocations close to its long-term targets. So having said that, we will still be looking for a more attractive entry point along the lines of the recent market sell-off, but we just want to have the infrastructure in place to accommodate that. And number 2, as Vince has alluded at the beginning of today's meeting, next month we will bring in you some ideas on how to move into more risky asset classes. So that move will in turn take care of excess allocation to core fixed income and to cash, bring it down, and further will allow us to breach that gap between interim and long-term targets. That would be all, and I will be happy to answer any questions you may have.
Huge. Madam Chair. So you're doing it for the land grant, the severance tax, and the early childhood?
Yes, and also tax stabilization reserve.
Okay. I was at a pension fund conference and didn't get a chance to listen to everything that was going on for the investment committee meeting. But this is a huge shift in what you're wanting us to do for the target and actually add a lot more risk. And to be honest, I don't feel comfortable voting on it today just because I didn't realize this is what you guys were planning on doing. So you're changing the passive and the active pretty significantly as well. I saw that. Here. And you're suspending the core fixed income in its entirety? Is that what that means?
No. So as far as the core fixed income is concerned, we are not making any changes. You can see in land grant, severance tax, and early neighborhood, the core fixed income remains very, very high. We have suspended the lower and upper limits 2 years ago when we came up with the current interim targets. So what we are asking of you today mostly are some marginal changes in our targets, because we are already, if you look at the last column, the April 2025 actual position, we are already at or a little bit below the lower limits of the long-term targets. So in order for us to move closer to the targets, the midpoint of the long-term asset allocation, we would like to make a couple of changes to the current interim target. So we're just changing the interim targets that we've implemented 2 years ago to bridge the gap and move closer to the long-term target.
Okay, Madam Chair, so you're not changing the actual
Oh,
asset
absolutely not.
allocation, you're just changing the interim target to move up to start aligning with it. So for
Exactly.
example, let's just go to U.S. equity.
Yep.
You have an interim target of 17.5, we surpassed it, we're at 18%, but our full allocation is 20%.
Exactly. So we are pretty much moving that interim allocation to the long-term allocation of 20%.
Okay, see, Madam Chair, I think for me, the only reason why I got confused is because you have an upper limit of 25% in U.S. equity. So that did shift.
That is in line with the long-term targets. If you see the lower limit target and upper limit for the long term, they are between 15 and 25%. So technically, we're moving the broad U.S. and broad international equity to match the long-term targets exactly.
But Madam Chair, the proposed interim changes on the upper limit are now higher than what the current upper limit is for equity. So you're not just changing the interim target to match up with the current proposed aligned target. You're wanting to increase the proposed upper limit for equity from 22.5% to 25%. So that is not, it's not true that you're just increasing the interim target. You're asking the council to also increase the full proposed new upper limit to 25% in equity.
Madam Chair, Madam Treasurer, if I could clarify, so, those current interim targets were set 2 years ago. The new upper limit of 25% exactly matches the upper limit for the long-term targets that you've already set. You've already decided as a council that you want a mid-range target of 20% for U.S. equity with lower and upper limits of 15% to 25%. This is essentially saying we're so close to that now, we don't need interim targets that are different from the long-term targets that you've set, and so they're identical.
Madam Chair, if I look at what RBK gave us today, looking at that same page 3 or page 25, the maximum allocation for private, for U.S. equity is 22.5. I know for sure this council never agreed to 25% in total for a whole.
That's the max on the interim target. Your ICS, your investment policy statement, has a max limit of 25%.
Yeah.
It's in the policy statement right now, that the long-term, strategic, and then also your rebalancing target, and 25% is in the ICS.
Okay. I didn't realize that, Madam Chair. I think that's something we should have Vince and all your guys' team evaluate if we really want to be up to 25%. I think the 22.5 is great, but going up to 25% in private equity, I mean, I know we did it, but I know we're in a whole different market right now, and I've seen a lot more reports and documentation that says we should be cognizant of that between 20 and 25 mark. I'd just like you to evaluate it, but thank you, I get it now. Okay, further questions? Is there a motion?
Madam Chair, I'll go ahead and make that based on the recommendation of the Council Investment Committee, Advisor RVK, and SIC staff. I move that the State Investment Council approve the interim asset allocation target changes as discussed and memorialized at today's meeting.
Second.
Second, Nick.
We've got a proper motion from Chair Bingham and a double second by Member Tejas and Member Summer. Any discussion on the motion? Hearing no discussion, can we take a roll call vote on this motion?
Commissioner Stephanie Garcia Richards.
Yes.
Treasurer Laura Montoya.
Yes.
CFA USA Secretary Wayne Cross. Yes. Dick Tayes,
Yes.
Catherine Allen,
Yes.
Don Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
That's none in the affirmative, motion passes.
All right, thank you, and thank you very much. Okay, now, we're gonna get into our investment votes. We're gonna go to agenda item 8C. Yeah, see, I missed the, sorry, thanks for letting me know. Are we don't have anyone in person for that? No?
Let's see, it's ready.
We're in D.
Yeah, sorry, right.
Okay, Madam Chair, council members. So today we're going to cover U.S. public equity structure study. We've got Matt Sertivan from RBK with us, Ryan Eustace from staff, and we'll jump right into it. So we're on page 244. So we're going to review the current portfolio purpose, objectives, and strategies. We'll review the proposed changes and rationale, and then we'll talk a bit about next steps. Next slide, the process flow chart. This is a flow chart you've seen previously today, just to highlight where we're at in the process. And you can see those orangish boxes are what we're working through now in terms of presenting a structure study. Then we go into the portfolio construction, manager due diligence process, and then bring that back to the council in the future. So the current purpose of the portfolio is to generate significant returns for the permanent funds, provide a high level of liquidity, and to provide exposure to economic growth in the U.S. So this is a consistent purpose for the portfolio. That's not going to change. You can see on this page, we've got long-term capital market assumptions. This is something that RBK puts together. 6% is obviously towards the lower end of the asset classes. If we, 5 years ago when a structure study was presented, that was 6.8. Since then, markets have actually done 18%. So it's something to be taken with a grain of salt, I think. It has been a really attractive asset class, but I think Matt can speak a little bit to how those numbers are put together by RBK.
Very briefly, and hello everyone. The reason it's come down is because of the success of the U.S. equity market. Very high returns, high valuations, spending long-term. That associates us with a much lower long-term assumed rate of return. What I will say as a preview for some of the other comments we'll make where the structure is going, there's been comments today on the increased risk or volatility of the overall U.S. equity market. That's something we're hearing. We also have seen over time that when you have a lower rate of return, as we are assuming we will for the next 15, 20 years, that tends to be a more favorable time to take active risk, take opportunity on top of that lower return. So we'll talk more about that. But Greg is right on. This is an assumption that has gone down over time, and that's because the U.S. equity market has outpaced expectations in the last decade plus.
So next slide, slide 248, current objectives of U.S. public equity are to outperform the Russell 3000 index by 20 basis points net of fees, to generate significant returns through diversified U.S. public equity market exposure, maintain a beta of 1, and low tracking error of 0.25% to 1%. The strategy of the portfolio is to construct a benchmark neutral portfolio to achieve that target beta of 1, where the portfolio is going to have a similar style, similar market capitalization, similar sector exposure to the broad index. This portfolio has been positioned to have a significant allocation to market cap passive indices and a smaller percentage to actively managed strategies. So the current allocation is 68% to passive indexes, 32% to active. Again, passive portfolios are benchmark strategies, and active strategies are actively managed trying to beat the benchmark. So we just want to take a minute to talk a bit about risk. This is a slide that I shared when I presented the international structure study last year. So just to explain again what tracking error is. Tracking error is the risk that we deviate from market returns. And I think it's important to recognize that low tracking error doesn't necessarily equal low risk, and we'll talk about that in the slides going forward. But we want a low risk that we're going to deviate in a meaningful way from market returns. So if the portfolio has a tracking error of 1% and the market returns 10%, 68% probability that we're going to be within 1% of that market return, 9 to 11. With that tracking error of 1%, 95% of the time we can expect to be within plus or minus 2, so a second standard deviation event, where we're going to be between 8 and 12% in that environment. So that's what tracking error is telling us. What tracking error doesn't capture, and this is the next page, is just that absolute risk, that market risk that we're taking. I think sometimes passive strategies can be construed as being low risk, but you're still taking that market risk. So this is just looking at S&P 500 rolling 1-year annualized returns. And you can see on a 1-year basis, you can get widely different outcomes. So it's just good for us to keep that in mind, that there's going to be periods where returns can be really negative, or there's going to be periods like the last couple of years where it's north of 20%. And that tends to move in a pretty wide band. And I'm not telling you anything new there, you know. But this is interesting to me. I think when you look at it on a 10-year annualized return basis, so this is rolling quarterly going back to 1960, there's only been one short time period where on a 10-year basis you lost money in U.S. equities, and that was the 10-year period during the Great Financial Crisis, where it was starting from the peak of the dot-com bubble and ending at the trough of the financial crisis. And outside of that, generally speaking, investors have gotten a good outcome from being invested in U.S. public equities when they've got a long-term view and are long-term investors as we are. And since 1960, that average return for U.S. equities has been 10.5%. So 10.5% over a period where there was 3 times where the market went down 50%. So early 70s, dot-com bubble, Great Financial Crisis, and even through all that, returns are north of 10%. So how often do big corrections occur? 350% corrections over the last 50 years. The smaller corrections happen more often. We've actually had 3 20% corrections over the last 5 years. We just had a 20% correction where we bottomed out right around, just briefly, after the tariffs were announced. And if you blink, you missed it, because we're already back above where we were before that started. So that's just a reflection of how volatile and risky public equity markets can be in the long term, in the short term. Long-term investments are rewarded. When corrections happen, so as this correction was happening in early April, we were having conversations in our strategy meeting. Okay, so we rebalance on a monthly basis. So what do we want to do at the end of the month? Where, you know, if we're at a 20% correction, are we going to rebalance back to target weights? And generally speaking, that's what we're going to do. We didn't get the opportunity to do that because by the end of the month it had recovered a lot, but just to give you an idea of how we approach that kind of market volatility and try to take advantage of it, to our benefit. And then this is a slide that RBK, supplied, so I know, Matt, you wanted to speak to this one?
Yes, and this goes to what Greg already mentioned, that passive indexes, they're inexpensive, they are giving you with the market returns, but it does not mean they're riskless, because you're accepting that market return without any active selection within that passive vehicle. So they're very useful, they can be part of the portfolio. What this chart is showing you on this page in the dark blue and turquoise color is we are at a point here on the right side of the graph where the top 10 holdings of the Russell 3000, which is the U.S. equity index, represent a very large percentage of the overall market, meaning a lot of the capital in the U.S. equity market is concentrated in a small number of companies you know and have heard over time, such as Apple, Microsoft, Alphabet. What that is coinciding with, and that's represented with the Russell 1000 PE ratio, so just a form of valuation for the large cap market, dark blue, is that we are at a point where we both have a very high level of concentration and also high valuation for that large cap market. And what that points to us is not that it can't necessarily go higher. There's been points along this curve where you could have said, well, this probably is the peak. We're not trying to call it a peak. What we're saying is that at some point you start getting closer to a ceiling where you get more volatility. It gets harder to outpace expectations. And we're somewhere around that point now.
So with that, I'll cover real quickly current structure, risk, and performance. So just to highlight that the portfolio has been managed in a way that's consistent with the prior structure study. So on slide 256, this is a style analysis. So these boxes represent in the upper left corner large cap value, large cap growth in the right, small cap value, small cap growth on the bottom. We are the diamond, the X is our benchmark, and you can see that we're very tight with the benchmark, and that's part of our goal, our objective to be benchmark neutral. And one of the things you look for in a style analysis is their drift, and there's been no drift, so that's a positive. Slide 257, this is the tracking error. So in 2020 with that structure study, the tracking error target was reduced, so we've been within the appropriate range since then. Slide 258 is the beta, so we've been targeting a beta of 1.0 since 2020, and have achieved that as well. Sector exposure is something that we always look at. We want to be fairly close to benchmark sector exposures, and you can see that we are. And market cap exposure, we're also similar to the benchmark in terms of weighted average market cap. So in terms of the 20 basis point net of fees goal, we haven't quite met that, but we have met the second objective, which is to be ranked better than median for trailing periods. So you can see this portfolio, even though it's trailed the benchmark net of fees by, since the reconstruction by 37 basis points, that still was better than 68% of our peers. So the biggest risk that U.S. public equity has faced over the last 5 years is the opportunity risk of not keeping up with the market. And this portfolio has largely done that, to the tune of nearly 18% on an annualized basis over 5 years, which cumulative is about 130%. So a really good run for public equities. Current managers, there's only 5 strategies. This is on page 262. There's only 5 strategies in the portfolio, and as we talk about our recommendations, you'll see that we'd like to, especially as this portfolio has gotten larger in terms of dollars invested, to diversify some of this and have more strategies in the portfolio, to not have so much risk concentrated with single managers. And then slide 263 is the performance by strategy. So I'm going to move into the proposed structure now. So I'm going to tell you what our recommendations are, and then we'll walk through what our rationale is for those recommendations. and then revisit those recommendations after talking through that. So we would recommend increasing the excess return goal from 20 basis points to 35 basis points. We want to try to achieve that by modestly increasing the amount of active exposure in the portfolio, so shifting from a portfolio that's 32% active, 68% passive, to 50% active, 50% passive. And I'll give you more details on what that will look like. Increasing the active exposure will likely lead to a slightly higher tracking error. So we're recommending moving from 0.25 to 1% to 0.75 to 1.5%, which is actually the same tracking error that we target for the international portfolio. And we want to continue to maintain an approach that achieves broad market-like exposure to domestic public equity, so we still want a target beta of 1.0, which is the same strategy we're following in the international portfolio. So if we're recommending a bit more active exposure in the portfolio, I think it's important to talk about the puts and takes of active versus passive. Being more allocated towards passive over the last 5 years has been it's been a good cost-effective strategy. As I mentioned, haven't quite kept up with the excess return goals, but we've kept up with the market and delivered really strong returns. So as Matt was alluding to, market concentration and mega cap outperformance in the U.S. have created a structural headwind for some areas of active management, in particular large cap growth. So we'll talk about that a little bit. But I think it's interesting to see that history tells us that this level of concentration and outperformance does not persist forever. So next slide, 267. This is a manager excess return summary for active managers in U.S. domestic equity, and it's by asset class. So this is a chart or a table that we've shared before for international when we worked through that structure study. But what you're looking at is the top quartile, median, and bottom quartile managers in each asset class, and what the average excess return on a 3-year rolling basis net of fees has been. So for the top quartile managers, you can see that excess returns for large cap growth in particular have been very narrow at only 1.2%. But as we talked about in the international asset class as well, when you look at the small and mid-cap spaces, the amount of excess return available is higher. The hit rate represents the percentage of managers that delivered excess return over the 3-year rolling periods. So take U.S. small cap core, the hit rate is 77%. So that means 77% of managers outperformed the index. And the top quartile managers outperformed the index by 3% on an annualized basis. So those are, that's a particularly attractive asset class to utilize active management over passive. The opportunity to get excess returns is just more prevalent, and the hit rate is higher. So us, as we're doing our due diligence and picking managers, we have a better opportunity to identify those managers and get them into the portfolio. So the real question is on active versus passive is, do you even want to bother in the large cap space? In large cap value, you can see the hit rate is 61%, and the excess returns available are higher. Large cap growth has been lower, and this is looking back to January 2001. So a solid, 20 plus years. But I think it's interesting to point out that a lot of that has been driven, right, by that market cap concentration, by the Magnificent Seven outperforming so much. Last year, market was up about 24%. The Magnificent Seven, I think, were up 65, 67%, something like that. So when you have that concentration, what does that mean for active management? And how should we then approach that? So slide 268 is a good way to kind of think through this, I think. So this was put together by MSCI. So they're looking at a few different eras when we experience the kind of market cap concentration that we're experiencing now. So this is going back to the 70s and this is looking at individual company concentration across the world. So it's not just the U.S., but this is looking at the MSCI World Index. And back in the early 70s, there was U.S. blue chips. So the 10 largest firms in the MSCI world were all U.S. companies. And it was IBM, AT&T, Exxon, GM. So it was an era of, kind of similar to what we've experienced now in the U.S., where globally stocks are dominated by the largest U.S. companies. And then we went through some other periods where global oil majors were a big part of it. Japan financials really bubbled up there at the end of the 80s. Then the dot-com bubble, we got that concentration in Microsoft and Cisco and Intel and Lucent, Nokia. And now they're calling it the AI onset era. I think I would call it the U.S. blue chips part 2 era. It's kind of modern U.S. blue chips that are dominating. So the Magnificent Seven, Apple, Microsoft, Amazon, NVIDIA, Google, Tesla, Facebook. So we're in another one of those eras. So when you're at this peaky level of concentration, what happens next? So slide 269. What we've seen in the past is those 10 largest firms at the beginning of each era had a smaller weight a decade later. So you could see it with the blue chips, where they were approaching 25% of that index, and 10 years later, those same companies were about 10% because they matured, maybe some of them went down, new companies bubbled up and took their spots. And I think we can reasonably expect over 5, 10, 15, 20 years that we see something similar, where these really large companies now, some of them mature, some of them roll over, new companies emerge. So how does that impact our view of how much active exposure we should have? I think this informs it as well on page 270. When I talk about a structural headwind for large cap growth managers, they've been structurally underweight the Magnificent Seven really since 2017. And a lot of that has been a function of those companies have gotten to be such a big weight in the index. A lot of those funds, if they're registered as a diversified fund, they can't own a 15% weight in Apple like their index may have, or Microsoft at 12%. So that gets reflected in this underweight, and that impacts the excess returns that have been available in the large cap space. So our large cap growth manager, T. Rowe, is a non-diversified fund, registered as a non-diversified fund. Doesn't mean they're not diversified, but it means they can match those bigger weights. And so relative to their peers, they've done quite well. They're top quartile, haven't quite beat the index, but they've been top quartile in that space. And I think this is an important fact, because as you look at the last 10 years and what this represents. So the top line is top quartile managers and their excess returns on a 3-year rolling basis. So it's basically taking that table and putting it into a chart. What I think is interesting here, though, is when you look back previous to the Magnificent Seven era, which has been the last 10 years, you can see that the excess returns generated in the large cap growth space were much higher and much more reliable. And that big spike you see there is that's the dot-com crash. So when you also get into a period where the market is correcting, then active management, especially coming out of a period where there's been a large amount of concentration, active management has been a place where you've been able to get more downside protection and generate more excess returns than we've seen in recent history.
Can I just add something there, Greg?
Yes.
Because the decision 5 years ago to become more passive was one that, those last two charts we looked at, that type of information really informed that decision. At the time, you saw active large cap growth managers and active large cap managers being a little more like the index, meaning that they didn't feel like there's a lot of differentiation or alpha potential outside of that top 5 to 7 names in the index. We've seen them start taking more active risks. So we do listen to the managers out there, meaning that they're starting to see some more potential for outpacing the returns of those really strong companies. And then Greg pointed out and noted that just because these companies are successful and represent a large part of the index, that doesn't mean they can't continue to be successful. But there will be competition, and there will be companies bubbling up. This isn't, again, necessarily calling a peak or a major downturn. What this is doing is saying, historically, there are times when there's a better chance to take active risk within this type of portfolio, within the U.S. equity portfolio. That doesn't mean taking more risk. What we actually mean is having the same exposure to U.S. equity, but having more opportunities to add value within that portfolio through potential increased volatility. And so I think that's a good delineation between taking more risk, which we're not doing, and trying to exploit a market, which can be difficult to do. But timing-wise, 3 to 5 years ago, there's indicators of moving something closer to a balanced portfolio can make.
Yeah, and we're talking about this a lot. You'll see as we talk more deeper around the recommendations, we're not advocating for a huge shift into active versus passive. But we'll get more into that in just a few slides. And part of that active versus passive debate is, through our due diligence process, can we take managers that will be top quartile, above median, that will outperform? So we can't guarantee that, but we think we have a good process. We have a rigorous due diligence process. We focus on consistency in terms of process, philosophy, people, and culture. We want to mitigate risk and ultimately select managers based on merit and portfolio fit. We, just like you saw with the international portfolio, we have a process that's very open. So we want the broadest pool of candidates that we can get. And we want to allocate to multiple active managers as opposed to how we're positioned now, where there's just a couple of them. So we're diversified across more than just a couple of active managers to reduce that single manager risk and increase flexibility when we need it. So as an active passive summary, we're recommending shifting from 32-68 active passive to 50-50, 50-50, excuse me. The main reason why excess return opportunity in the small to mid-cap asset class is attractive. So we want more active exposure there. We think it's reasonable to assume that the excess return opportunity in the large cap asset class can improve in the future. And we believe in our process around manager selection, along with in our partnership with RBK. So back to the structure study recommendations. So a small increase in our excess return goal from 20 basis points to 35 basis points. If you remember, for international, our excess return goal is 50 basis points, and our active passive exposure in that portfolio is 75-25. So for this portfolio, we're recommending going to 50-50, not moving to a 50, but to a 35 basis point excess return goal, expanding the tracking error risk budget, so there's a little more appetite in the portfolio to have a bit of that deviation from the benchmark, but it'll still be, instead of 1, it's 1.5, so it's still a pretty tight tracking error. We're still targeting a beta of 1.0. What we think the portfolio will look like in terms of that 50-50 split and how that looks for active and passive. So the portfolio is about 90% large cap and 10% small cap. So in the small cap part of the portfolio, recommending very likely, we obviously have to go through the process and build a portfolio and then come back to you. but it'll likely be a small cap portfolio moving to 100% active exposure from 75% active, 25% passive today. The large cap portfolio moving to 45% active, 55% passive from 35-65 today. So still in the large cap space, we'll have more passive exposure than active exposure, but taking a kind of a small step to add a bit more active exposure, and, you know, hopefully give ourselves a better opportunity in the future to deliver on those excess returns. Next steps will be to issue a request for proposals. So we'll be seeking candidates across market caps and styles. As I mentioned before, it's a very open process. We want as many candidates as possible from across the spectrum, from small firms to large firms and everything in between. We'll follow our 5-step due diligence process to identify what will probably be 3 to 5 strong candidates in the large cap space and 3 to 5 in the mid cap space. The managers that strategies and managers that we currently have in the portfolio, the majority of those will likely stay in the portfolio, but that'll be part of that analysis process when we come back with a prospective portfolio based on this structure study. And with that, I'll take any questions.
I actually have tons of questions, and I feel bad because it's already 12:45, so I don't know if you guys want me to ask questions or you want to wait till the next meeting, but
If we're gonna vote on this now, you should probably ask questions.
well, if you guys don't want to hear me ask questions, I can table and then we can talk about it next. But I'll start. Okay, so increasing the excess return goal from 20 to 35. I keep hearing that everything is modest, but 15 basis points is significant. I guess for me, I need to start off with how much money are we talking about, or what percentage of our total portfolio is in this portion?
When you say in this portion, what?
Well, of what's going to be impacted by us making these changes.
Yep. So I think page 274, I think that kind of lays out what it'll look like. So the small cap space moving from 75% active to 25% active to 100%. So that'll be a shift. The actual exposure to small caps will still be around 10%. And then in the large cap space, basically 10% of the portfolio moving into large cap active from passive. So that's the main shift, is taking a little bit out of passive and moving it into active. So we'll still have, within the large cap space, 55% exposed to passive as opposed to the previous 65.
Madam Chair, in dollars, what are we talking about?
Let's see, if we're thinking about a $10 billion portfolio.
As of March.
Yeah.
Give or take $10 billion, so we're moving, let's say $9 billion of that is large cap. So we're moving 10% from passive to active.
About $1 billion.
Yeah, 900 million to $1 billion.
Yeah.
From passive to active.
Yep.
Okay, so of that $1 billion, when you're transferring over from 35 to 50/50, 18 points, to me doesn't sound modest, it sounds very significant. And I know that there's a difference on passive and there's positives and negatives, both for passive and for active. And we really didn't talk about those that much. I know that there's a difference on legal liability on passive and active. You're looking at funds as well, correct?
On
So
legal liability?
For example, with Tesla, or one of the ones that I've emailed you guys about, we say we take a passive role, so we can't take on the main effect of the legal issues with it because it's not active. So if it's active, then now positive or negative, we could take an active role in whatever lawsuits might occur because of whoever we decide to invest in. Is that correct?
No. I mean, if there was if if there was a class action lawsuit, as shareholders, whether we're in a passive fund or an active fund, we'd still participate in that. I think for our active managers, in terms of proxy voting, we could have more impact there, if we wanted to. General practice for proxy voting is that our managers who are doing the investing vote proxies. So in terms of us being activist investors, we don't take that role, or we haven't historically.
Madam Chair, I think even though we might still take action in the lawsuit as a secondary, when you're active, you become a primary, correct? Is that how that works? You can?
Let me step back, would it be okay if I step back and
Yes.
sort of try to help?
Yes.
I think we're talking about two different things. We're
Okay.
talking about the liability of the manager, which is something we agree to by contract about what they're gonna do and what they're gonna perform. And I think what you're talking about is the potential liability of an underlying issuer, the actual company, and what the regulators and shareholders and other people might sue them. We fully participate through our custody bank in all such actions, class action type of stuff, against issuers. So I think that's the disconnect in the two things. What we're talking about here is simply, do we want to have, and that's what you're getting to, do we want to have passive, do we want to replicate an index, and forgive me for the oversimplification, do we want to replicate an index or benchmark, whatever we're replicating, or do we want managers, given the varying charts that you saw online, to I don't want to say make bets, to make an educated decision based on their expertise, time frame, process, and so forth to outperform. And I think that's the distinction of what Greg is asking you to allow us to consider managers who might bring a value of 0.18.
Using Tesla as an example, in the passive vehicle, we're going to own Tesla, whatever weight it is in the benchmark, whether it's a good investment or not, right? So do we want to hire people to actively look at that and make a judgment around, is Tesla a good investment? And not own it, or own it at a bigger weight if they think it's a great investment. But in terms of, our ability to participate in lawsuits, et cetera, we're shareholders, so we have all this, between in a passive vehicle and an active vehicle, we have the same shareholder rights in both cases.
And Madam Chair, to that point, because it could be considered a positive or negative, the passive, for example, there's a lot of funds or others that have said we don't want to invest in Tesla right now. And the argument is we can't do anything about it because this is a passive index. So on an active index, you would have a little bit more control over who you invest with, correct?
Well, so for an active manager, we're doing due diligence on them, and we're selecting them based on their merit. We think they're a good investor, and we're hiring them to make those individual stock investment decisions on our behalf. And then we monitor those, and if we have issues with what they're doing, we have direct access to them to talk about that. But we are hiring them to make those investment decisions, just like we do in the other asset classes, when you hire a manager.
So Madam Chair, hiring the managers, that's going to be done by RVK, similar to anything else we do, or is that going to be in-house?
No, that's done in-house in partnership with RVK. So when we did the international portfolio last year, you remember earlier this year, we brought, based on that structure study and then the RFP, the manager search, we had 12 new managers that we brought to the portfolio, and we conducted that due diligence process in partnership with RVK.
So Madam Chair, how many staff are under you in your division?
It's me and Ryan.
So that was the other question I had, is that if we don't we already are so tight on capacity, and you're also doing all of public equity, correct?
Mm-hmm.
Which now it is a lot more of a percentage than I thought it was to begin with, but it's a lot of money.
It is,
We're
yeah.
looking at about 15 billion in total, correct?
Between domestic and, international, it's more than 20.
More than 20
Yeah.
total.
Yeah.
So when I'm thinking of everything that this council has done this last couple of months to try to get the new hiree, we have to double up on that. There's literally only 2 of you, but we're increasing right now, or being asked to increase by 18%. I just feel like this is setting you guys up for failure. It's not that I'm opposed to the idea. Just right now, I feel like I'm opposed to the idea because all signs point to not setting you up for success. Like the idea of a better rate of return, the idea of having more power, authority, and control over who we're what managers we're selecting, all of that sounds wonderful. There is some risk to it. There's operational risk. There's liability there.
Like the cost.
Yeah, it'll be,
to the cost yet.
yeah, so fees, overall fees will be a little bit higher, yeah.
I said I had a lot of questions.
Yeah.
But the first part of it for me was, am I setting you up for failure? Because I know you guys are brilliant at what you do, but there's only 2 of you. If
Yeah.
you have a family emergency or somebody's sick or someone wants to actually go and take a vacation, there's literally only 2 people managing over $20 billion, and now we're asking to do an 18% increase to active. Like, who has the oversight of all of, like, a person that can be great, but they can only do so much, believe me, I know, because you guys get the emails late at night from me. I just think that part is concerning. The other part that's concerning.
Can I address that?
Yeah.
So I think we're well positioned capacity-wise to take on this project. You know, what it'll ultimately look like, I think, is the number of strategies in the portfolio going from 5 to something like 10 to 12. So adding a few more, you know, we will be adding some strategies. But I think it's also important in terms of our fiduciary duty to have a diversified portfolio. I think it's the concentration that we have in individual managers right now is too high. So 18% of the portfolio is in our one large cap growth manager. That gives me heartburn. I feel like we should have that diversified across a few more managers. And it also allows us to consider a broader range of managers when we're not trying to invest $2 billion with one manager. And, you know, we get a lot of support from RVK. It's not just Matt, there's a whole team behind Matt. So it's Ryan and I on staff, but it's RVK as well. Vince has a ton of experience, so he helps us out a lot as we work through these things as well. So I don't know, hopefully that helps with your concerns around that, but I do believe we have the capacity to do this, and I think it's an important step forward for us to take from a fiduciary responsibility standpoint.
So, Madam Chair, that was a lot. I would say our fiduciary role hasn't changed from before this meeting to currently this meeting. Throwing out our fiduciary role, I would say, why hasn't our fiduciary role to change this a long time ago? Why do we not still, with the 35%, be able to allow for, I mean, there's more than one person or one entity that can do it. You could do that shift right now, still intact with a 35%, the 35-68 split. There's not just one entity out there, so we don't have to shift to 50 for you to be able to diversify. So that's a little misleading.
Yeah, it's a different argument, yeah.
Yes. The second thing I would say is, we sound like we're talking out of both sides of our mouth, because on one side, we're being told we need to hurry and hire double what we have needing staff. But then I'm hearing you say, there's 2 of us, and there's still the same consultants we had before, and we're great. We'll be fine increasing 18%. Now, let's go to, I mentioned risk, I mentioned the legal ramifications. For me, I feel like this is such a big deal that I need a second opinion, like when somebody tells you might have something medical, you need a second opinion. I feel like there just needs to be a little bit more information because this is such a huge shift. I don't understand the 0.25 to 1% to the change of 0.75 to 1.25, and I also don't understand cost. And I didn't see a lot on the cost aspect. For me, it would be helpful to see that 18% shift. What does that look like from a cost perspective? And then, of course, then from there, factoring in, you know, when we have more staff and how that shifts off that cost for an overall positive rate of return in general.
I mean, so I guess, kind of behind the scenes maybe, you already did the cost benefit analysis, but like, it's gonna be an increase in fees. But you think we're gonna like more than make up for that, is that what you're saying? Like, 'cause we're not seeing that comparison. We're gonna be.
No, but
paying
you'll
more.
see that in the next step. Once we have gone through the portfolio construction process, and we'll show you the efficient frontier of the prospective portfolio, what the fees look like versus the prior portfolio, versus the current portfolio. I think fees on this portfolio were at 10 basis points.
Yeah, right around.
Blended,
Yeah.
because it's 70% passive essentially. So I think in terms of fees, when you're thinking about the cost benefit of fees in the public equity space, because of our size, we can invest in active managers in a fee range. In the large cap space, it's probably 20 to 30 basis points. And in the small cap space, where it's a juicier opportunity to deliver excess returns, probably 40 to 50 basis points. So there's no lockups, there's no performance fees. So to me, when we're thinking about all of the different asset classes we have, fee-wise, this is one of the most attractive.
Madam Chair, what I think would be helpful for me too is on the portion that we currently have, active versus passive, being able to see what those costs look like today, and then what your proposal is that you think that it's gonna look like later. And then you mentioned it a little bit at the end, your 5-step due diligence process to identify 3 to 5 strong candidates. I wrote down what you said about what that sort of looks like, but I would really like to see what that due diligence packet really looks like when it's gonna be done by only our powerful team of 2.
Yeah, and if you remember with international, we presented over multiple slides, a more in-depth look at what the due diligence looks like. So it'll look like that. And, you know, we'll review that in the next step as well, but I'm happy to, you know, if you want me to come back, I can come back and we can talk through that in more detail. The plan is to issue an RFP. You know, we can share what that RFP looks like if you'd like to see that. It's a very comprehensive document that really helps us with our process.
If I could offer just a couple thoughts. So the team that you referred to as RVK, including myself, 7 people who are working with them. On that team, when I look at the coverage of each team member and the managers they're really focused on, ones that we're recommending actively, that tends to be, let's say, an average of 20 managers per person. So in this case, with 2 people between the 2 of them, between U.S. and non-U.S. equity portfolio, you're looking at around 20 or so combined, so about 10 each. To me, as just from my seat, what I ask from my team is certainly within the capacity. And what this represents is a move back towards a structure closer to what the number of managers was in place prior to 2020. So it's a similar move back towards the number of managers prior to that point.
Yeah, when you look at this portfolio 10 years ago, I think there was 14 managers, and now it's gradually dwindled down to 5. So that's part of what we're recommending is moving back towards more diversification. And we do have plans to, you know, add another person to this team as the year goes on.
But to clarify,
Yeah.
the shift in the 14 managers to 5 is not because of the 35% split. It could diversify currently.
Yeah, and not increase the active exposure,
I
but,
want to make sure
yeah.
we all understand that part, because that's not the problem.
No.
You could easily change that right now. You're just wanting to change it completely to the 50%.
Yeah.
Sure. So when I looked at that chart of the fees, I mean, it looked fairly reasonable except for the top one, was pretty significantly higher than BlackRock was significantly higher. You you think that you'll be below, significantly below those fee costs?
So what we're looking at here, so zero, this is our large cap active manager, 36 basis points. Can you go back?
Yeah, sure.
Yeah, 36 basis points. That's for a large cap manager. I think we can probably do better than that. And that's, going through this process I think it'll help us achieve better fees because we'll be able to negotiate with managers and get the best fees possible. The BlackRock Alpha Tilt is 44 basis points, so that's a small cap active strategy. So 44 basis points, that's a pretty attractive fee, I think, for a small cap manager. Yeah. Yep.
Yeah, and that'll be part of the analysis through the RFP that we would come back with is where they actually each fall in line with peers. Right now, these look good versus peers. To Greg's point, decompression has occurred over the last decade. We hope to see some more of that. But that doesn't discount what you all are saying, that to increase active allocation, that does, by dollar, increase the fee. There's no way around that. But for a manager, we would make sure that they are attractive versus peers.
Yeah, and going from essentially 70-30 to 50-50, if we're at about 10 basis points now for the blended fee, maybe it goes to 15 to 20, probably with a bit more active exposure. So that's the cost benefit analysis. Is it worth that? Are we going to get excess return? So if we're doing that in the small cap space, if we get top quartile managers, we think we can get 3 to 4% of excess returns on an annualized basis. And that feels worth it to me, but like I said, when we come back with the portfolio construction, you'll be able to see that, and just like we did last time.
That's after this vote, though, so.
It's after this vote, yeah, but that is what you kind of generally expect, I think.
What were you gonna say, Evan?
I'm gonna try to be helpful without arguing any position. I think that, and the only reason I'm speaking is because there's been words like legal liability and fiduciary this and that, and, which is right and which is wrong, and I don't think what I'm going to say is anything to deal with that, although I've heard all the comments, I'm trying to balance that. I think what Greg and his team, within the team, is saying is, can I come back, I want to take on work, and I want to come back to you in 5 or 6 months, and it's going to be a lot of work, and try and convince you that because of varying fees or anticipated returns or market issues and volatility and or concentrations, that I think, because I've worked with this group, that you should vote to do something. Right now, what he's asking, I think, to do, and please correct me if I'm misstating it, is I'd like to do a transparent, public, very inclusive RFP to consult with experts in the industry, specifically managers, hopefully a lot of them. And I think I have the time to do this, and you may regret it, but with everyone's help, to try and sell you in 5 or 6 months that I think for a variety of reasons in 5 or 6 months, this is a good idea. It's similar to what we did in the international portfolio. Active management might be better because there's 7 to 10 stocks that are really dominating. Whatever the case may be, it might be in your interest to have a more active role in saying we can invest in this kind of thing or not, whatever the case may be. So, and he may take the position that I'd like to get on this sooner rather than later because it's kind of scary out there for a variety of reasons, tariffs or whatever else, or valuations or PE highs or whatnot. So I think what might be lost, I'm not suggesting he wasn't clear in the treasurer's comments, is we're just asking permission to take a look and do a little extra work. We're not doing it ourselves. I mean, he thinks he has a team to do it. We're certainly not doing the management ourselves eventually, and we're just asking permission to make a case to you at the time when he thinks, because of his resources that he has, that he can, with his team and with Vince and with our consultants, and hopefully the managers, make a compelling case that this is good for you for the following reasons, and then you can accept it or not at that point, but he's willing to take on the work, and everyone's willing to take on the work to do it. I'll stop because I think it's kind of in your interest, but I don't want to suggest that I'm right.
And when we bring that prospective portfolio, then you have the opportunity to vote on it again at that point and say, no, we don't think it's worth it because of the fees, or we don't want that activated. So it's, to Evan's point, it's the beginning of the process, and it just doesn't just give us carte blanche to then do the portfolio. It still has approval processes after that as well, and there'll be a lot more information for you down the road.
So we have member Sanchez who I haven't heard from, is that okay? All right.
Yeah, I hear the treasurer's concerns, and they, set off alarms for me, important ones, many times. Then I also just thinking of the environment and the timing of where we're at, in the world with the tariff threats, everything else, it seems so uncertain, but the opportunity to move, and we can pull the plug at any time on it. I mean, we can always tweak it or stop it, and that gives me a confidence in, as a council, that we have the power to correct course if we need to. So then that makes me feel more confident that I think the recommendation, the timing is what matters, and that would make me have a positive vote for it. Yet, still wanting more answers as we go along with what the treasurer has brought up.
And I think it's important to point out too that we're still recommending a market neutral portfolio of beta of 1.0. So a small expansion in the tracking error, which is just the deviation from the market. So we're not recommending a structure that gives us more market risk or more absolute return risk. That's not the goal here. The goal here is to expand the active exposure a little bit, to better manage that risk, and especially in your point, we seem to be in more volatile times, more uncertain times in terms of tariffs, geopolitical risk, and those are environments, those more volatile environments are ones where active managers tend to add more value. So that's kind of what the point I was trying to make.
So, Madam Chair, I have a question. You're asking about, the 14 managers dwindled down to 5. Why haven't you guys added more managers in the meantime or in this report?
So, you've got more history with it than I do, but I think, in 2020, the decision was made to, that structure study went from, it was 70% active, 30% passive, and flipped it. So in flipping it, we're able to allocate a big chunk of assets just to the Russell 1000 benchmark. So that's a big part of it, I think.
So, and I don't want to put words in staff's minds or mouths at all, but this path we're following now would have happened over time either way, whether there's a change in staff in the last year and a half or not. And the rationale then would have been more to this point of resiliency of, and to your point, this can happen with 32% active too, but an increased number of active managers within the portfolio, there's less single manager risk. The reason it hasn't happened is just timing, staff changes, and processes that kind of got disrupted by that.
And Madam Chair, just to clarify something, that if we shift to the 50%, how challenging would it be if we decided to go back down to, let's say, 35% active? What would that timeframe be? What would that cost? What would that look like?
It would be the trading cost of moving out of some active, reallocating from active managers to passive. We'd obviously need your approval to do that. That would involve another structure study, I would assume, would be the mechanism to do that. We're working through that process right now with the international portfolio. So we work with a transition manager, we work with our custodian, we work with RDK, and execute on that. So
if, Madam Chair, we didn't make a decision today to get more information, for example, are you guys going to continue to have only the 5 managers, or are you?
Yeah, and we, you know, to make it clear, the change to those 5 managers, no change will happen until we've gone through the RFP due diligence process. So literally 6 months from now, we come back, present a prospective portfolio, with details around fees, with the efficient frontier, with what the tracking error beta would look like under this prospective portfolio compared to the current portfolio. So this is the first step in the process, and that's why it's higher level and less detailed, because those details kind of come out.
That one better be
later.
stellar, because it's literally gonna justify my vote today, literally.
So, Madam Chair, just to be clear from what Evan said, this vote says that we would be adopting the strategic recommendation of the U.S. Public Equity Structure Study.
Mm-hmm.
Does that mean that we're validating the 50-50 today?
Yes.
Yes, but then you also, as we bring the prospective portfolio and those new managers, and you approve that as well.
So then that's when we'll be able to see more detail on what the fees are, more detail on what their cost benefit analysis kind of
Yes.
calculation is.
Madam Chair, I sort of like to get into a car and know where I'm going before I actually get in the car. Other people enjoy the ride. I would really like, during the interim of this month, to see what that cost looks like currently versus before, what the split looks like today versus what your anticipation of it is. I want to know where I'm going before I actually go there. I'd really appreciate it. And that includes mostly the cost and the fees, and then the due diligence perspective of what you're looking at, what that's going to look like from your end, from internal staff then.
Yeah.
Madam Chair, if I could just add.
Yeah. Yeah.
That, part of your approval for the structure study today is what would allow Greg and Ryan to pursue the process of the RFP, which would allow them to get the estimates from the managers on what those fees would look like. We can speculate now, but until we get that, RFP input, it's hard to really know what that would be. So for example, you could approve the structure today, allow them to engage in the RFP, come back with the proposal, the manager's fees, et cetera. At that, and in that interim process, everything's going to look like it does now. Once you see that RFP proposal, then you basically have a chance to revisit this again. Does this still make sense? Do we want to approve that structure? In theory, you could see that proposal after the RFP, after we know what the fees would look like, and say, here's what the portfolio would look like. You would have an opportunity to say, you know what, we're actually not comfortable with this fee proposal. We're not comfortable with what this would look like. And so at that point, you could then revisit the structure study to go back to the same active passive we have now. And then we could even benefit from having gotten responses from the RFP on additional passive managers, et cetera, that could be added. So I just wanted to add that context. The decision now is essentially what the staff needs to be able to move forward with the RFP in order to get the information.
You're letting them put the address into the GPS, but we don't know where we're gonna end up.
Yeah.
And if we reach that point and the council is not comfortable with a 50-50 active passive, we can stay with the current active passive exposure, but diversify our managers, with what we've discovered through our RFP process.
I want to hear actually from, Officer Smith on just your thoughts on just 18% shifts, 18% shifts. That's kind of large.
I was gonna weigh in on the history side, but Matt did it pretty well, so I didn't have to. So back in 2020, when we did that study, the markets had really crashed during COVID. And, everybody on the planet knew the Fed and all the central banks were just gonna come in and pile money in and markets were gonna explode. In that kind of environment, you want a passive portfolio. The active managers just cannot keep up with a market like that. So it worked, the structure worked. Now we're sort of at the complete opposite end. We've got really high valuations. We've got extreme concentration in the market. These are type of markets where active generally outperforms. So we'll either get kind of bouncy markets, Could get a big downturn and then some volatility, in markets. But this position, or at this time in particularly the domestic equity market, this is where active management outperforms. So moving from, kind of 2/3, 1/3 to 50/50, that makes sense to me. When Greg initially said he was thinking about 50/50, we talked about it. When he finished up the structure study, I went through it in detail. So I think it's a good move. You wouldn't be seeing it if I didn't.
No, I don't know. I just wanted to hear your
Yeah,
thoughts,
sure.
because you were kind of silent.
I think we're in a good spot for what he's presenting.
Did I cut you off? Did you want more?
No, that's okay. Go ahead.
I think we're in a good spot for doing what he's suggesting.
Madam Chair, I think the biggest thing to keep you alive, keep you awake, would be not having more managers. And so, whether or not this is approved today, I'd say start that process, because it takes time, and you've got to go through a whole RFP. I'm in favor of doing what you're talking about, but in any event, I think you need to go down that road. And get those managers on board so that we can talk about it.
Yeah.
And the sooner the better.
And what I'll do when we come back with the prospective portfolio, is I'll present a 50/50 prospective portfolio, and I'll present a 32/68 portfolio. It's either a shift or no shift, and I'll present a in-between as well. So you can kind of see on the efficient frontier and the effect on fees, with a few different options.
Anything further on this dead horse? Anyone online? Great conversation.
Thank you.
Online,
Yeah.
anyone? Do we have a motion? Oh, Member Tejas.
Madam Chair, and I think we've kind of, like you said, beat the dead horse here, but I did want to ask, and maybe it was said earlier, but how long will it take to identify a manager after the RFP?
So, judging by the international process, so last year we issued the RFP in June, end of June, early July, something like that. The managers have about a month to respond, and the RFP is done publicly, so Charlie helps us publicize it, and different organizations pick that up and publicize it, and we get a bunch of responses. I would anticipate for this RFP, hopefully we get 100 responses, if not more. And then we start our 5-step process. It's kind of working down a funnel, where we kind of eliminate and gradually whittle it down to the point where we're doing on-site due diligence with every manager that we're going to end up recommending, and some that we don't. So that process last time took from July, and then we wrapped up due diligence and the portfolio construction process in November, and then we presented it to the council in January. So I would expect you could expect a similar length of time on that process.
Okay. Yeah, I would urge the council that time is of the essence. I've been very concerned about the concentration risk within our public equity asset class, especially with the activities of leadership of Tesla and what has gone on with that company. I've been very, very concerned about how that affects our portfolio. And I think it's something that we seriously need to be staying on top of. And I'm happy to see that the management is looking to address, concentration risk with the Magnificent Seven. I don't know how magnificent one of them is, but I think that is something that this council really needs to stay on top of and really figure out what kind of risk we want to have with a company that has been, operating in the manner that they've been operating. So I just want to put that out there and urge you all that time is definitely of the essence. If we're not going to get an RFP together by January at the earliest, let's not push this decision too far down the road. Just my comments. Thank you.
All right,
you. Do we have a motion?
Madam Chair?
Yes.
Based on the recommendations of the Council Investment Committee, Advisor RBK and SIC staff, I move that the State Investment Council approve the findings and adopt the strategic recommendations of the U.S. Public Equity Structure Study as discussed and memorialized at today's meeting.
Do we have a second?
Second.
Okay, we have a motion and a second. Any discussion? All right, motion by Member Sanchez, second by Member Summer. Okay, so let's take a roll call vote.
Commissioner Stephanie Garcia Richards.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Props. Yes. Nick Tayes.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes, and I'd like to thank Mr. Dunn and his team for undertaking this study.
It's 9 in the affirmative.
Thank you. Thank you.
Okay, agenda item 3E, Advent International GCE 11.
Yes.
Private equity.
Yes, ma'am.
Right?
I'll say almost nothing. We have 2 re-ups this month. The first is a firm called Advent that runs a global private equity firm with a tilt towards Europe. As part of the commitment, we're setting up another side-by-side co-invest vehicle, which would be our R8. This would be our 3rd commitment so far by Advent.
Thank you, Madam Chair. We do have 2 re-ups today that have performed well for the national program. Advent's an existing relationship. There's been $120 million committed across the last 2 funds. Advent's one of the older private equity firms out there, started in the early 80s. The things we like about the strategy, it does have a flexible strategy. They focus on global opportunities, and so they'll do investments in North America, in Europe, in Asia Pacific, and really kind of compare where the potential investments are across the different geographies. They're also sector focused across industrials, business and financial services, consumer, healthcare, and technology. And over time, they've really established a strong reputation in the industry. They currently have a team that's grown to 13 managing partners and 300 deal team professionals. And they also have 45 portfolio support group professionals to help with value add initiatives on the portfolio. They're also flexible on the type of size that they target. So they may be targeting a small company, a medium-sized or large company, so you do have that flexibility in the fund as well. From a track record perspective, the firm's generated consistent performance from each of their target regions and also have a good track record of generating realizations. The last 5 funds have had consistency over multiple vintage years. And for the SIC's commitments, although they're still relatively early, the performance has been 14.3% as of year end. From a benchmark perspective, most of the funds do rank above median across all 3 measures of IRR, net multiple, and distributions. Terms are typical of what we would see for more established firms, and so we are recommending a $150 million commitment to the main fund, and also a $150 million commitment to a sidecar co-investment fund that's no fee and no carry. I'll turn the time over to the Advent team.
Terrific. Well, first and foremost, thank you to the council for inviting us to present. We are grateful for the partnership over the last 2 vintages and look forward to a productive relationship going forward. My name is Dan Tortora. I'm a member of the IR team at Advent. I am joined by Tricia Glenn, who's one of the 13 managing partners of the firm. The managing partner group at Advent should be thought of as really the governing body of the firm, so she has great perspective. She leads our North American consumer effort. She sits on 2 investment committees. So we thought no better person to walk you through just a high-level overview of the firm, strategy, as well as the team.
Adding my thanks for the time this morning. I'll give just a few minutes of comments if that's helpful. But really pleased to be here with you today and appreciate the time that you're spending on investment with us. So as I said, the firm was founded 41 years ago. We were a pioneer in global private equity, and that's been at the root of our business for a very long time since. Our platform has about $86 billion of private equity assets under management today, and we do have 15 offices around the globe. We believe that local professionals who understand their local markets, build relationships there, identify investments, are best partnered together thinking about risk and return on a global basis. We, in many of our investment opportunities, do work across multiple offices, multiple geographies, to put the best team on the ground for that particular investment or that particular portfolio company. As I said, we are control-oriented, we are resource-intensive. We have our 45 folks inside the firm who are really focused on value creation, but that is a big piece of all of our investment professionals' work. We are looking to inflect the line of the businesses we invest in, really apply differential insight, resources, and look to put that business or brand on a different trajectory going forward for its future. The 302 investment professionals actually we have are spread across all 5 continents, and we do not have a top-down perspective on always having an equal amount of exposure by geography or by sector. Ultimately, we're looking for the best bottom-up ideas from all of those investment professionals around the firm. And that goes down to the actual idea itself. And so inside each of our geographies or sector teams, we build out something we call sourcing cells that are very deep in a particular segment, whether that's in beauty and my neck of the world, in the payments franchise, which has been a big global franchise for a long time. And so each of those sourcing cells are teams of folks inside Advent, but also external to the firm, operating partners who know their craft and their field and are operating these businesses today in the real world. We take that, really empowering the investment professionals one step forward in how we think about decision making. And so we have a series of investment committees which are regional in nature. We have members of each investment committee that do overlap so that we have a common bar for underwriting risk, returns, and thinking about the current deal-making environment. But the predominant decision makers for each region, be that North America, Europe, Asia, or Latin America, are each people who understand that region and invest in it every day. We did talk a little bit about our partnership model. The managing partner group is the governing body of the firm, but on top of that, we also have a group of 66 partners. We are a private partnership. We do not have third-party capital. We are not public, nor have an intent to go public, and we believe that partnership model provides real alignment with our investors. And we also believe it allows us to attract and retain spectacular talent in the investment industry. That's certainly the goal. I think with that, the only other thing I might touch on is the types of investments we do look to make. We are big believers that, again, we want to inflect the line of these businesses. We want to create real value. And that leads us to 2 major types of investments. One is acceleration. These are growth at scale. These are, I'll take an example from the consumer space, partnering with a founder to help them position the business for great long-term success. Some cases, that is providing the scaffolding around the business growing quite quickly. In other cases, it's bringing a replicable playbook that was used in many situations to help them grow the next phase, whether that's in e-commerce or social intent and social listening. And then the other side of the spectrum, outside of these growth acceleration deals, are transformation deals. These are carve-outs in nature. They're repositionings. These are businesses where there's still a growth business inside to be unlocked. Their future is always growth underlying. But there's some repositioning that needs to happen in that business in the near term. And for carve-outs in particular, we've done north of 85 of those in our career, and so, or as a firm. And so there's been many moments of scar tissue earned in some of those investments, but also great learnings that we do pass throughout the team. With that, I'm happy to pass back.
So, it's a re-up. What are the significant changes in terms from the last?
No changes.
No changes in terms, okay. Anyone else? Online questions?
motion?
Madam Chair, sorry, go ahead, Member Silver.
Go ahead, Mr. Bean.
Okay, based on the recommendation of the Council Investment Committee, Advisor Mercer, SIC staff, and the General Fiduciary Oversight of RVK, I move that the State Investment Council approve a commitment of up to $150 million to Advent International GPE 11 LP and an additional commitment of up to $150 million to the related Advent Co-Investment Fund, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Okay, we've got a proper motion by the Chair of the Investment Committee and a second by Member Summer. Any discussion on the motion? Hearing none, let's take a roll call vote on this motion.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya. CFA Secretary Wayne Props. Yes. Nick Tejas.
Yes.
Catherine Allen.
Yes.
Don Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer. Yes. That is 8 in the affirmative. Motion passed.
Very good. Thank you all for being here. Very much. All right. Agenda item 3F, JMI Equity Fund 12. And whenever you're ready.
This is also a re-up. This would actually be our 5th commitment to a group called JMI, which is a growth equity firm in the software space. JMI is actually one of our longest term relationships in the private equity portfolio since Mercer came on. They've performed very well. They've done it in a way, not only have they performed well, they've done it in a way with really keeping loss ratios very low since our relationship began.
Thanks, Chris. Thanks, Madam Chair. The SIC has committed across their last 4 funds, and the firm's generated a 24% net IRR for the SIC, which equates to about a 1.9 times net multiple as of year end. And this firm is focused on investments in software companies with high growth potential, and just some unique things about the strategy to be aware of. One is they do have a flexible approach. They can be a minority investor or control investor in a company. They do want to be the first institutional capital in companies, so that flexibility helps them approach the companies. They also have a proactive sourcing effort to really find companies away from the tech hubs on the coast. So think of Middle America, where they're finding the hot technology companies in geographies that you normally wouldn't find.
Silicon Valley, Nebraska.
Yeah, exactly. They've actually invested in Nebraska. Des Moines, Iowa is another place that they've had some success. So that's kind of a unique aspect to their strategy. The team has a lot of longevity. JMI has been around since 1992. They have 9 investment partners today who average 18 years at the firm, so a lot of longevity. They've been undergoing a long, multi-year succession that was clearly communicated with limited partners, and it's been running very, very smoothly. From a track record perspective, they've generated consistent net returns above median with many funds in the top quartile. And they've also been able to generate realizations, especially in what has been a difficult market. We saw sizable realizations in 2023 and 2024, for example. Alignment is above average with the large general partner commitment that they're making, and so we're recommending a $75 million commitment to JMI Equity Fund 12. And I'll turn the time over to Sukin Patel, who's one of the partners at JMI.
Good afternoon, everyone. My name is Sukin. I'm a general partner at JMI. I think the team here covered it really well, but just as a headline, at JMI for the last 33 years, what we spend our time doing is investing in growth software companies, and specifically business-to-business growth software companies. So in the same strategy, single fund, single focus, and where we drive alpha is being very focused on that end market, which is growth stage software companies that are business-to-business and focused in nature. When we think about our business, all of our alpha, again, drives to that domain specificity, but it spans every sector that you can think of, whether it be healthcare, education, security, selling to marketing. We kind of participate in the vast variety of GDP, all through the lens of a business-to-business software, focus. Our companies on average are in the growth stage. So typically an investment will be 25 to 40 million in revenue at the time we invest, generating about 40% growth, 70% gross margins, and 90%, cross customer retention. So high customer retention, high gross margins, and growing very quickly. Our job and focus is to help these companies scale very quickly and grow and capture market share. And to that end, we've developed a team behind our investment team that really helps drive the operations of these businesses and allows them to grow and succeed very quickly in each of their end markets, thereby increasing their strategic position and allowing us to execute liquidity. So that's a brief history and kind of overview of JMI. I'm happy to take any questions.
All right, questions on this? Fine. Is there a motion?
Based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and general fiduciary oversight from RBK, I move that the State Investment Council approve a commitment of up to $75 million to JMI Equity Fund, Roman numeral 12 LP, subject to and contingent upon the New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, completion of appropriate paperwork.
Second. All right, we got a proper motion by Member Summer, a second by the Treasurer. Any discussion on the motion before the Council? Seeing none, if we could take a roll call vote on this motion, please.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Frost. Yes. Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Tingelman. Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
Those eight in the affirmative, motion passes.
Okay, very good. Thank you all for being here with us. And finally, real assets vote in Whole Street Energy Partners 3, agenda item 3G.
So, Madam Chair, in August of '24, we approved, or SIC approved, the initial investment in Whole Street Energy Partners 3. That commitment was $150 million. Whole Street is an investor, leading investor in the marketplace for producing renewable and conventional power. The firm is 100% employee-owned and is led by Sarah Wright, the founder of the company. Sarah is joining us via Zoom today to be able to answer any questions that you may have. At the time that we established the initial portfolio position, our assessment was that the pipeline was not going to be sufficiently robust to set up a dedicated co-investment vehicle. Since August, the world's changed quite a lot, and the pipeline now looks quite robust. And as a result, we're seeking $75 million to dedicate to a dedicated co-investment vehicle. Amy?
Yeah, I would say we have spent some time looking at their pipeline. It looks quite robust, so we do feel like the amount of capital we're putting in it would actually be called. That's one of the things we want to make sure of when we're doing these co-investment vehicles, so we're not tying up capital that never gets called. So we feel comfortable with the pipeline, and it is a fee-free, carry-free co-investment vehicle. And I would just mention Whole Street did reach out to us proactively. They wanted to make sure that New Mexico SIC had the opportunity to take advantage of the very ample co-investment pipeline. So that was really showing the strength of the relationship that they actually pinged us and said, hey, let's take a look at this. So we appreciate that from Whole Street. So yeah, we are also in support of creating this co-investment estimate.
Sarah, would you like to make a few comments?
Sure. Hi, Madam Chair, members of the council. Thank you so much for having me. I think Keith and Amy did a great job of covering it. As you guys recall, we take a very holistic approach to investing in the power sector. And one of the things we spend a lot of time studying is kind of like how one technology displaces another over time, and the investment opportunities that come out of that. And what we are seeing most recently as, kind of this current first quarter, is that, demand growth continues to escalate. We're seeing that across a number of different markets, very recent demand growth forecasts coming out of control areas and utilities continue to surprise to the upside as it relates to demand growth. On the other hand, the political landscape recently has, I would say, done a bit to constrain capital allocations to building new assets, building new renewables, and kind of reprioritize things. So what you're seeing in a way is an uptick in M&A activity, which makes power really an outlier in this environment. I think M&A activity more broadly has been stymied, in particular by sort of tariff dynamics. And so with that uptick in M&A activity, you have more people trying to buy stuff, more people trying to sell stuff, more people changing their strategies from sort of renewable focused to gas-fired power plants. And this is the kind of environment we love. It creates, whenever the world needs to restructure their portfolios, this is where we like to intermediate. So we're pretty excited about the opportunity. We are seeing some pretty active opportunities that are, would require co-investment for us. As a reminder, we are middle market strategy. We are, $2 billion fund, so smaller for real asset category. And in particular, we're seeing assets in the hydro category, in the operating renewable kind of wind and solar category, where previously capital costs were subsidized to some extent. That is ceasing, and in that context, those assets become more interesting to us. And then, of course, we are not doing anything to alleviate the existing headwinds around getting new gas plants built and interconnected. So that leaves a lot of opportunity as it relates to the existing assets. So we are pretty excited about the opportunity. I'll just leave it at that. I'm happy to take questions if anybody has any specific questions. But this is kind of what has created the shift around our expectation for the quantum of co-invest capital that we may require.
And I misunderstood this at first. So we already voted on the 150.
The 150 was approved in August of '24.
Okay. Any further questions? Any questions?
Madam Chair, just to clarify, the 150 was approved, this is the co-investment, but is the fee that's in the confidential part of the 150, or is that the co-investment?
That's part of the 150. This will be fee-free, carry-free. There will be nothing on this co-investment line. Yeah. We put yes.
Got it.
We put the original memo in there just to remind everyone, but yeah.
Do we have a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $75 million to a co-investment separately managed account with Hull Street Energy Fund 3 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you.
Okay, we got a proper motion by the chair of the investment committee, Member Bingham, and second by Member Tejas. Questions on the motion before the council? Discussion. Hearing none, let's take a roll call vote on this motion.
Commissioner Stephanie Garcia Richards.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Props. Ms. Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
Nine in the affirmative, motion passes.
Okay, very good, thank you.
Thank
Very
you
well
all.
taken. All right, let's go to hear from our CFO, agenda item 4.
Madam Chair, fellow council members, just two items I want to touch upon on slide number, I guess it's 487. The last item, external audit services. I just want to note for those of you
who haven't been notified that Moss Adams is to merge with Baker Tilly, as of the end of May, 1st of June, as I understand it. Just wanting to let everybody know that. I know the treasurer has been in communication with us. It will impact the agreed upon procedures report, that is in process right now. Moss Adams is gonna sign that. Actually, they expedited this third quarter, actually completed that and delivered it, so we'll be sending that out. But as far as our annual audit is concerned for fiscal year 25, it will be signed by, Baker Tilly. The Office of the State Auditor has been consulted by Moss Adams and Baker Tilly. They're all on board. We still have to submit a name change for the audit firm, but I just wanted everybody to be aware of the change that is coming. Other than that, same standard audit or budget to actual schedules, as well as the investment holdings report. That's all I have today.
Questions for Brent? All right, great. So we're going to actually now move to public comment. Remember, we amended our initial agenda, so I'll turn it over to Mr. Woolman.
Madam Chair, at this point, we have one person who has signed up for public comment. He is on remote, I believe. Carlton Bird with ATI Partners.
Great. Thank you. Thank you so much, Madam Chair, Treasurer Montoya, members of the council and staff. Very pleased to be here this afternoon to give you a brief introduction to American Triple I. My name is Carlton Bird. I'm a managing director at American Triple I. We are an infrastructure fund manager based on the lower middle market in the U.S. We were founded 6 years ago by Henry Cisneros, who has a long family history in the state of New Mexico and went on to be two-time mayor of San Antonio, also HUD secretary. Henry built this firm with the notion and the theory that there was a much overlooked segment in the U.S. infrastructure market, basically in the lower to mid-market areas, where there wasn't as much competition by some of the larger managers. And when you dig even deeper to perhaps those areas that focus on disenfranchised communities, maybe minority, rural, other communities, where infrastructure needs are very important, where funding might not always be there, that there was a real opportunity for private capital. Now, we thought about this in 2019. I joined the firm 2020 after a long time at a major emerging market infrastructure fund. And we started our first investment redeveloping JFK Terminal 6 in New York and Queens. Ended up being a $4.2 billion public-private partnership, which ends up being the second largest transportation public-private partnership in U.S. history. A lot of that was attributed to getting through the challenges of COVID during that time, but also the notion that there was stakeholders involved in that project that could have been overlooked if there wasn't a firm like ATI who understood those dynamics. So we've taken that to be a very core part of our strategy, that when we're going into some of these lower to mid markets and knowing the need for private capital, that we may see things a bit differently than others. We don't have as much competition when we go into these markets for assets, and we're not based on the M&A market solely. We end up doing several public-private partnerships. Of course, we have the JFK T6, which is on track, on budget, should be opening up early next year after getting through the COVID doldrums. But most of our markets have experienced a lot of demographic shifts. All those dynamics that we saw early on are still happening, and those areas that are in need of transportation, social, or digital infrastructure are still in existence. And we find ourselves being mainly, I guess, the type of firm we are, with a very experienced team, even though we're only a 6-year-old firm, with a desire and the knowledge that if we work together and work with our public and private stakeholders, that we can come to an agreement on how to integrate private capital into much needed infrastructure projects. We've come to become a leading partner for those who are seeking the same type of exposure, might I say. And we currently have $830 million under management. 390 of that was in one asset, that was JFK. We also have City of New York as a investor with us through their consultant BlackRock on another separately managed account. And we have a $400 million separately managed account with one of our investors from JFK, who's a European fund manager who's looked at us to be their eyes and ears to the US market. What this has allowed us to do is we have a $500 million fund target. It'd be our fund one, but we're not first-time investors. It'll be our fund one, but it's given us a lot more capability to seek out what might be larger investments that can be in a $500 million infrastructure fund, but also have the backing of a large European infrastructure, well-known infrastructure fund manager in Europe, and also give opportunity for co-investment to our LPs. So I'm here today. Thank you to you, the staff, and the council, Treasurer Montoya and Madam Chair, for giving us a chance to speak. We'd love to get the chance to tell more of our story to your investment staff. As I mentioned, we're in the market for our Fund 1, $500 million target for American III. Of the open for any.
Thank you, Mr. Bird. Thank you.
Thank you very much, folks.
Okay. With that, we're now going to move to agenda item 5 and hear from the chair of our Governance Committee, Chair Allen.
Thank you, Madam Chair. And we need to go into executive session. I can read a motion to do so if you would like. Okay. We need to vote to enter executive session for discussion of state investment officer performance review pursuant to the New Mexico's Open Meetings Act, NMSA 1978, Chapter 10, Article 15, and so forth, in accordance with New Mexico Attorney General's Open Meetings Compliance Guide. I move that by a majority vote of a quorum of the State Investment Council, that the council enter closed session today solely for discussion of limited personnel matters pursuant to Section 1015(1) H2 NMSA 1978, specifically regarding the job performance of State Investment Officer John Clark. It requires
there's a motion by the chair, at Chair Allen, a second by Member Summer. Any discussion on the motion? Hearing none, we have to take a roll call vote on this motion, please.
Commissioner Stephanie Garcia Richards.
Yes.
Treasurer Lauren Montoya.
Yes.
SA Secretary Wayne Frost. Yes. Nick K.S.
Yes.
Catherine Allen.
Yes.
Don Dingeman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Summer. Yes. None in the affirmative, motion passes.
Steve B. and Chris Rodriguez, who was that?
Okay. Is everyone out now?
No.
No.
We'll give
Okay.
you the high sign.
All right.
I'll monitor it, well, I won't monitor it, someone else